gold. I want to take that trade too, but let me go get my laptop from my car. You know what? I left my jacket inside. Is that Santa's? Oh no, not again. Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 10% off, you can use code A1TradingDF10. Again, that will be 10% discount off of any of their trials you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
All right, guys, welcome back to the stream. Sorry for the echo. That was my bad. We're good now. Welcome back, everybody. Make sure, as we just got started, you saw our newest sponsor, DNA Funded. There's links and promo codes down below in the description if you'd like to check them out. If you feel you're ready to take on the challenge of getting funded, definitely one to check out and do your due diligence, see if it's the right fit for you. We've got a few minutes to go here before we get the producer price index numbers here this morning, which could be market moving. We'll have to see. You know, yesterday's CPI report kind of didn't do a whole lot to the markets in terms of market volatility. In some ways, it gave the stock market another excuse to run higher because yesterday's CPI report came in line with expectations. It didn't scare the market too much, and the market's been in party mode. So, you know, not turning off the music allowed the stock market to keep going higher. The question today is the producer price index potentially going to spook the market anyway? Are we going to see an uptick in the PPI or the producer price index? What's the difference between these two? Well, the consumer versus the producer are two different ends of the supply chain kind of thing, right? If you think about, you know, when you go to the store and you pay for goods there, there's been a huge, process in order for you to be able to purchase that product off the shelf, right? The supply line to get there. Well, the producer price index looks further up the chain. It looks at wholesalers, producers, basically inflation before it gets to you, right? Before the markups go into the goods at the store, what kind of inflation or what kind of price changes are happening on the wholesale level. So wholesale numbers, or the producer price index number, is going to be coming out here this morning in about 10 minutes. We'll see if that causes any stir in the markets. I've seen producer price index numbers where it causes a big move in the market, and I've seen moves that are very small or uneventful. The other one is, of course, the unemployment claims. And anytime you get jobs data, that has the potential to also move the market. So, and when I say potential, I do mean specifically potential, right? Sometimes people get all sorts of confused. They say CPI yesterday, it didn't do anything. It didn't cause a move. Well, remember, what causes moves out of news events would just be surprises to the expected numbers. So we've got expected numbers for the producer price index here. We're expecting a 0.2%, both for core, which excludes certain, more volatile inputs to the producer price index, like food and energy. And then for the headline, which includes food and energy, we're expected also to have a 0.2% rise in prices month over month. Now, here's the thing. How will that impact the charts? Well, we'll have to see what the number comes in. If you get a strong, higher than expected inflation report today, that would act to strengthen the dollar. It would probably put some pressure on the indices. Gold and silver, commodities would not love that, right? Rising strength in the dollar would potentially hurt that story. And the inverse would be true as well, right? If you get cooling inflation figures, then you may also see the opposite to be true. You might get gold have a little bit of a pop, right? Stocks could continue to rally. Stocks and gold want to see inflation continue to cool. The dollar wants to see inflation stay sticky due to a strong, economy. If you get unemployment claims as well, that's another thing to keep an eye on. So currently, I'll show you where I am generally kind of looking. I'm still bullish overall on the top setups here. We've got NASDAQ. Let me see. So NASDAQ, we've got gold, platinum, euro dollars back on there, which is interesting. Copper, the Nikkei. So these are some of the bullish readings that I currently have. And on the bearish side, let's just flip this score around. Really light. So really only getting dollars are on there, which is not a currency pair that I trade. So yeah, I mean, pretty much a light watch list today. What we'd be looking for on the gold front, by the way, would be again, break through this level of resistance, right? If you can get prices going here, if the producer price index comes in cool, we may have a bit of a catalyst to potentially move higher in the price of gold. Again, watching this 2,700 level to see how things react. At the end of the day, we don't know what the producer price index numbers are. We don't know what the unemployment claims are going to be. So we react to what's happening. I said this yesterday for like 5 minutes. I dedicated to this rant, so I won't go very long. But please, if you're somebody who looks at these events as opportunity to make quick money, I'm going to buy it right before or short it right before or something like that, please be really careful. We don't know how this stuff is going to come out. We don't know what the numbers are going to be. If you knew what the numbers were going to be, and if it was common knowledge somewhere, the prices would have already moved to the right places, right? If I knew today that inflation was going to come in really high or really low, I would already go and place those trades, and the markets would move based on that. So we're trying to just wait and see what happens and get a better idea or understanding of what might come next. Indices here are flat this morning, have not really made any big moves. We had a big up day yesterday on the NASDAQ. S&P also had a good day yesterday, and the Dow Jones actually had a poor day yesterday, held down by healthcare, utilities, industrials. There were some sectors that did poorly yesterday, but technology and the mega cap, right? The ginormous companies, Apple, Amazon, Google, Nvidia, did overall pretty well. So something to think about on that front. Bear with me, guys. I just got to respond to a message really quick. So yeah, anyways, when it comes to current setups for me, I'm looking at the NASDAQ with interest. However, not at these prices. I'd have to see a pullback for a couple days or even a week or two to really get interested in some setups. But the NASDAQ just looks so strong. It does not want to come down, it seems like. And it's been that way for some time, right? You've just had this up, up, up and away market move. Nick, how quickly does the Edgefinder update itself after news is dropped? Good question. Whoa, why does that format look different on our streaming software? It actually kind of looks cool. The timers are, you can, if you have the Edgefinder, head down to the data updates and sources log, and you can see when data is updating. So most of these things are on hourly or 15-minute intervals. And so our software is pulling data all the time across a large spectrum of different market data. So you can always check the data updates and sources log for individual pieces or things that you're looking for intel on. I also want to check the put call ratio. This has been something I've been looking at recently a lot. Put call ratio is still really low. And typically when this gets really low, I get a little bit more cautious on, the indices, etc. Big thing here is that you've got, what is the put call ratio? Why do I pull it up so much? Well, the put call ratio simply looks at the volume of puts versus the volume of calls on the options market. Puts are a way to bet on bearish setups. And typically when this chart is going up, it means the volume of puts relative to calls is increasing. And when this is going down, it means the volume of calls is rising relative to puts. So when this thing is really low, people are really bullish. When this thing is really high, people are really bearish. And right now we're sitting in territories where everybody is very bullish. It doesn't mean that the market can't keep going higher. It just means that when it flips, and I sound like a broken record, I know, when it flips, it could flip violently to the other side. So that's why, and that happens a lot with indices. That is the interesting characteristic of indices, is when everybody gets really bulled up, like over here, when it flips, it can suddenly drastically move lower. Look at how fast this move happened. Check this out. So this move up in the NASDAQ took 77 days to make a move of 21%, which is, by the way, an incredible move. But then look at this. To erase those gains, when the market got spooked, it erased those gains in just 25 days. It took 1/3 of the time. Well, what's my math on that? Yeah, 1/3 of the time in order to correct and move lower. So indices, long story short, they typically float higher slowly and then they move down very quickly when they do. So I'm trying not to get caught on the wrong side of this. Indices could continue to float for a while, but for me personally, I just don't see the risk reward at these levels. So I'm waiting for pullbacks like a broken record. If we get them, great. If we don't, I'll just trade other things. I do also, like I said earlier, I like the idea of looking for setups on gold. I'm looking for breakouts at these levels, 2,700, etc. If we can get something like this, especially if we get a cool inflation print, I like that setup. Looking to trade gold long. But if we don't, then I'm just going to wait. And that's been the theme, is a lot of trading, unfortunately, is a lot of waiting. It's a lot of doing nothing. If you're in positions, you trail stops. In my case, right, that's the way I trade. So if I have good trades running, I'm kind of just holding things and letting them run. And if I'm not in things, I'm waiting for pullbacks, waiting for proper setups that marry up nicely with the Edgefinder's kind of fundamental view on market data. Good question, Benny. I have an interesting question. There are multiple kinds of data releases. For example, GDP, preliminary, final. What data does the Edgefinder use? For GDP, great question. GDP uses all three, or the Edgefinder uses all three GDP numbers. It uses the advanced, which is the first one, preliminary, which is the midpoint, and the final, which is the finalized numbers of GDP. It factors them in, and it computes the score algorithmically for every asset. Hopefully that answers your question. But yeah, we've thought through that. The Edgefinder has been a very very detailed project for us for the last few years, and we're always thinking of ways to try and improve it. By the way, if you guys would like to try out the Edgefinder, we'll drop the link here in the chat to where you can get a 30-day trial. If that is something that you're interested in, if you're serious about market data, you'd like to try out our tool, look at things like the put-call ratio, commitment of traders data, seasonality data, economic data. If you'd like to try out the Edgefinder, take a second to click this link here where you can apply on our website for a trial of the tool. 30 days access. Check it out. We've got just a short period here before the news comes out, about 40 seconds before we get the producer price index numbers, which could move the markets, could not, just depends what the numbers are. Dollar index is up here this morning. Let's see if it can hold those gains on potentially higher than expected producer price index numbers. Lower ones would probably move the dollar down. So we'll see. We're coming in, breaking news shortly. Just about 10 seconds to go. Let's see what we get. All right. Unemployment claims came in higher than expected. Core PPI came in as expected. And PPI came in higher than expected. Interesting. So sort of a mixed report here if you think about it, because of course this is weak for the dollar. This is strong for the dollar. You had an uptick in inflation, but you also had an uptick in unemployment. I'm wondering if that's a positive response for gold. Slightly positive. Stocks pretty flat responding to that. Dollar index, let's go look at some charts individually. The dollar index initially moved lower, blipped lower here. Not a huge response though. And then pushing back higher here. Let's take a look at euro dollar. Euro dollar's been trading lower here in the last several hours. By the way, I have a long position on dollar Swiss, which is going well because the Swiss National Bank actually cut rates by 50 basis points when they were actually only expected to cut by 25. So Swiss franc is weak this morning, which is great for my position. I am long dollar Swiss. So we'll see. I'll update that position in the VIP room, by the way. I did this morning just kind of give a commentary on dollar Swiss franc, but looking interesting here. The dollar looks decently strong, especially against its peers. NASDAQ slightly lower here this morning. We'll see if that can give way to a bigger pullback. Again, I mentioned this 1,700 times, but I'm really only interested in the NASDAQ if it can give me a larger scale pullback. And at this point, you know, 3% gets you here, 6% gets you here, 9% gets you here. I mean, those are all healthy pullback levels that I think we very easily could see. I'm not necessarily bearish on the market per se, but I do think that the market is a little bit stretched. I think that sentiment is stretched as well. And again, sentiment can stay stretched for a while. I just think that for me, what that means, when sentiment gets really stretched, guys, people ask me sometimes, Nick, how do you use sentiment, right? Because on the Edgefinder, we also have this tool called Retail Sentiment. People love this tool. Let's go just look at our major currency pairs. How do I actually use this indicator here on the Edgefinder, right? Well, what I look for is I look for contrarian readings, not necessarily as entry timing tools, but as added confluence to an idea. So let's take a look at dollar CAD. Why not? Dollar CAD currently, dollar CAD has been trading up, and away. And what I find interesting about this is that, look at this. Dollar CAD is actually really bearish in terms of retail positioning. Retail traders seem to be shorting dollar CAD as it drifts and trends higher and higher and higher. The reason I bring that up is that that is getting us a contrarian bullish signal on the Edgefinder, because believe it or not, retail traders are actually trying to short this rally. You might think, well, does that mean everybody's chasing it? Well, actually, interestingly enough, retail traders are actually trying to fight this move. They're trying to short this move continuously, right? They're trying to bet against this move, and the market just keeps ripping through their stop losses higher and higher and higher. So that actually, to me, gives me like this slight bullish lean to continue to look to play that move until it truly changes directions. So sentiment can be really useful. It's not necessarily a great timing vehicle. I don't use sentiment as a timing vehicle. I use it as just a confluence to ideas or setups that I like, whether it be from the fundamentals and technical side of things, kind of as a confluence. So yeah, again, kind of a mixed report here this morning. Producer price index was hot, but unemployment claims were light, as in worse than expected. So a mixed response here. Let's take a look at some more charts just to see how things are responding. NASDAQ slightly lower, S&P slightly lower, Russell lower a little bit, Nikkei's down a little bit. So let's take a look at gold. Gold, again, mixed response kind of makes sense if you think about it, right? Because what's this going to do to the dollar? Well, unemployment claims weak. That should weaken the dollar, but PPI was high. That should strengthen the dollar. So we would expect kind of a mixed response, which seems to be what we're getting. And if you're disappointed by this, you're like, oh, I was hoping for a really violent move one way or the other. Just remember that most of the time, the market doesn't get big surprising numbers. Most of the time, the market kind of gets what it was thinking. That's what makes big, huge news events sometimes really exciting, is when they are very surprising. But today's numbers, and yesterday's numbers for that matter, were not super surprising or shocking to the market. Again, producer price index was higher than expected, but unemployment claims was also worse than expected. So you get this mixed response for the dollar. So that makes a lot of sense. For me, the way I'm going to score this personally is, again, a +0. Because if we were to say, let's talk about dollar bullishness or weakness, this would be a +1. This would be a -1. So they just kind of cancel out. It's neutral. I know it's kind of boring, right? It's not exciting. It's not, oh my gosh, we have a huge, massive, decisive day in the market. I know that that's more exciting and we kind of, those days are fun, but today's just maybe not that day in terms of market data. Getting a little bit of a neutral mixed response. And maybe that is very much showing up here in the NASDAQ, where we had this big up day yesterday, and this data kind of just brings you back to a little bit more neutral. So maybe neutral point is literally right there in the middle. So I don't know, NASDAQ down a little bit here today, not the violent moves. Guys, volatility also, if you're a Forex trader, gold trader, index trader, doesn't matter. This chart should be on your watch list. This is the VIX. And it surprises me, not everybody knows about the VIX. I mean, the VIX is, to options traders out there, this is the holy grail, right? This is the dollar index for options traders, basically, right? Currency traders love looking at the dollar index. Index traders love looking at the S&P. Options traders love looking at the VIX. But every trader, there's two charts that I would ask you right now to add to your watch list if you don't have them already. You ready? Two charts, the VIX, and what do you think the other one is? Hint, it's not gold. The two charts that I would encourage you to add to your watch list are the VIX and the 10-year government bonds treasury yield. These two charts, Raj gets it. This is it. This chart, so important. This chart, so important. If you walked into the stream today and you say, I don't look at the VIX or the 10-year, I'm telling you, these are two of the most important charts in the financial markets. Doesn't matter what you trade. Both of them matter so much. Okay? Again, if you're a gold trader, it drives me crazy. Sometimes people say, I only trade gold and I only look at gold and I never look at anything else. It's like, okay, fine. Like, do your thing, but why are you watching the stream? We're talking about fundamental analysis here. We're talking about what really is moving the markets. And I'm telling you, the VIX and the 10-year treasury yield, really important charts. I'll talk about both of them briefly. The VIX is important because it shows you, think of it as the fear and greed index in a chart. It's really important. When this thing is really low, what it basically telling you is that options traders who make up, there's a lot of volume in the financial markets that goes through options. Options traders are buying puts, they're buying calls, they're selling puts, they're selling calls. When the VIX is low, it's telling you that the market doesn't think there's going to be big moves. And when the VIX is high, it's telling you that the market thinks that the market's going to have big moves. And when I say market, I'm talking about specifically the SPX500, right? Which is a good indicator of the risk on, risk off sentiment. When this thing is high, people are scared. People think there's going to be huge moves in the financial markets. And when it's low, people are cozy, comfortable, optimistic, think it's all going to be rosy. Right now, it's like that, right? Everybody thinks, it seems in the market's perspective, that everything is A-okay. Things are good, right? The economy's good. Fed's going to cut rates. Geopolitics are going to improve, etc. Outlook has really improved in the last, actually following the election. Now, I don't say that to say, oh, it's because Donald Trump won, that's why the world is going to be better. That's not what I'm saying. What I'm saying is that the election was a big uncertainty event. People were really uncertain of what was going to happen with the election. And then when that faded, now we've got this very low volatility environment where people feel, okay, we're pretty good. Stocks are going to likely move higher. Cryptocurrency is doing well because, again, the VIX is low. So when the VIX goes high, what you will say, I'll say this for the rest of my time as a trader, most people's strategies work really well in either one of these scenarios, and very few trading strategies, actually, I don't know of any trading strategies, work well in both. Whether you trade Forex, gold, doesn't matter. During this period of time, typically things trend slowly higher in the stock market universe, and currency pairs don't move very much, right? They do, but they don't move that much. When this period happens, stocks are usually cratering really fast. Crypto is cratering really fast. So if you're somebody right now and you're like, I'm making good money, I am riding the crypto bull, I am trading the indices long, and I'm making money. Again, typically your strategy is going to work really well in a low VIX environment. If you're somebody who's doing terribly right now, you say, I need more volatility. I need big currency trends to take place. I need huge breakouts. I need gold to rip through the highs and make a more decisive move. Then you probably want the VIX to go higher, right? So my point is, nothing works all the time. This is why drawdown is inevitable. Nobody's trading strategy works all the time. You can have drawdowns and they can be ugly if you risk too much. VIX is really important. Add it to your watch list if you don't have it. I'm telling you, it's such an important chart. It'll add clarity to why the market's behaving a certain way. If you're like, I don't know why the market's acting weird, you may have gotten used to one environment and it switched, right? It's absolutely an important chart to add to your watch list. Because again, people get really confused. I only look at one chart. Well, great. You're completely blindsided to what else is happening, what external forces are impacting your chart that you love looking at. So if you only look at gold, great. But you could get some really good insights by adding some watch list items to understand why gold may be behaving the way it has. Look at what you guys want to see, why the VIX matters to gold, for example. Look at this. Up, up, up and away, gold was going. And look at what the VIX was doing at that time. You had a pretty elevated VIX, right? August, huge spike up. You had a relative high VIX compared to recent times. Gold's been less decisive with this fall off in the VIX. Uncertainty is a factor that helps gold. So when the VIX is low and uncertainty is low, gold doesn't do as well. Usually, not always. Right? So that's my thought. I just wanted to share that with you. The VIX is a really important chart. I'm an options trader as well, so I use it all the time. I like when the VIX goes up as an options seller because I can sell things for high premium. I can sell calls, sell puts for high premium. When it's low, strategies that typically work better for me would be being long the indices and trend following stuff, right? So just wanted to share that. It's a really, really fun thing. The other chart that I mentioned is the 10-year treasury yield. The reason this matters so much is this is the bond market trying to forecast what the Fed's going to do, typically, right? The 10-year treasury yield is how much money, how much return you're going to get by lending the government in the US your money. How much do you get per year? You get 4.275%, which is arguably a pretty decent return for a passive, return, just investing your money. That's a lot higher than it used to be. It used to be much, much lower. You used to stick your money in a 10-year treasury and get nothing. Now you get a decent 4%. Again, that's no effort, just 4% on your money, and you go on and do other things in your life. So my point is, when this rises a lot, that can tell you that people think inflation could be a problem. It tells you people think the Fed is going to keep rates higher for longer. And when it reverses, when it's going down, people think the economy might be cracking. The Fed may need to cut rates, right? So keep this also on your watch list. It is dramatically important for things like gold, things like currency traders, things like index traders. This chart is so important because the Fed matters so much to either putting the gas pedal or the brake pedal on the market. This is a good indicator of generally where they're going with that. I hope that was helpful to you. That's two charts that I think are really important to add to your watch list: the VIX and the 10-year treasury. The symbols to add to your trading view or MetaTrader or whatever you use is VIX and US 10Y. So, yeah, Sean, that's correct. Net inflation, a 1.3% gain. I know it sounds like nothing, but again, there's also little to no risk there. And I believe that there's also some serious tax benefits with a lot of government treasury bonds. So, you got to remember, when you make money in the markets, you get taxed on it too. There's some tax advantages there that, also matter. A a lot of this stuff, by the way, again, we track within the Edgefinder. If you want to track a lot of this data a lot better, I mentioned this earlier, but make sure take advantage of our trial that we're offering. It's 30 days access. If you'd like to try out the Edgefinder, see if it's right for you, get access to our sentiment indicators, economic data. If you're trying to get more into this stuff and understand the fundamentals a little bit better, take advantage. Take 2 seconds to apply for our trial, and someone from our support team will reach out to you with information and guide you on how you can get started using the Edgefinder to increase your fundamental analysis game. So take 2 seconds, click the link that's been dropped in the chat just now or in the description down below if that's easier for you and you're watching this at a later point. There you go. Okay, guys, we're going to take a quick break, and then we've got Miko and Marco joining us for Technical Thursdays, talking more charts here just after this quick break.
Attention A1 Trading Show fans, if you're interested in getting free access to the Edgefinder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we're back with Miko and Marco for Technical Thursdays. How's it going, guys? Welcome back.
Hello.
What's up? What's up?
Good to have you guys on the show and taking a look at some charts here today. Maybe we start with the dollar today. Dollar index has been up and away in the last few months. Seems to have, at least for the short term, found some support around 106. I'm curious where you guys are at with this. Bullish, bearish, how you're feeling? Maybe we can start with Miko. What are your thoughts on the dollar index itself or some of your currency pairs that involve the dollar that you're watching closely right now?
So yeah, I am keeping an eye on USD. It's, I mean, overall, I would be bearish because of where we're trading the higher time frames. We've come back to the top end of this range here around 107. So at these areas, I'm only looking to sell until we actually break through. And then maybe you might see a bit of a trend back to 113. So that's kind of where my focus is, looking to take some shorts. But at the moment in time, we've seen some upside and looks like we're struggling at this level. So my kind of bias, at least for the next few days, would be if we can hold on to this 106.7 area. I do think we're in store for a move back down. So possibly there could be some nice buys in Euro USD, which is the pair I'm looking at the moment, which is pretty much trading at the same area in respect to what the USD is doing, of course, with their correlation. Coming back into a nice area of support as well. So leaving behind a big wick at the moment. I'll be looking to take my entries on the 4-hour time frame. So I'll be looking for some engulfing candles in that direction. But it's in a nice area where, again, we could bounce and see a higher low. Should we break through this, then we might be seeing a pretty bearish Euro USD. And of course, if we do break through that corresponding level on the dollar, probably see a pretty bullish dollar back to the highs as well. So overall, I'm only going to be looking to sell because of where we are on the high time frames. But I want to see price reject this level and hopefully it can see some downside. But we respect the support really well on NFP, so I'm unsure how far it can go. If we can get a push back to here, that'd be great, but we may very well bounce again and continue higher. But that's kind of what my outlook is for dollar.
Makes sense. Looking at the higher time frames, weekly chart, bumping up into some levels of resistance. Dollar's been having some, some difficulty getting through this 107, 108 area. Perhaps, like you mentioned, maybe it's going to go retest that 100 level again at some point or another here. We'll have to see. Okay, so euro dollar, looking at potentially bullish setups on that front. If we can get some sort of candle confirmation, really cool. What about Marco? Dollar setups, any type, Aussie dollar, euro dollar, pound dollar. What are you watching today?
So I did try to get in on a buy setup right here on the Aussie and US dollar, counting on the Aussie strength and dollar weakness. I saw a descending channel and a nice momentum to the upside. Even on the daily chart, it looked pretty descending to me. So like some bullish price action was expected. So I got an entry as well, simple break and retest. So a little bit of a pullback, break of the high, with strength and then a retest of this level. Small stop loss, but I did get stopped out in the end. So this was a loss. Still bullish though. Overall, I do think the story is bullish for AU. For EU, I do think it's going to be pretty similar, kind of breaking the lows with weakness. Now pausing a little bit here. If I take a look at the DXY, on the daily chart, the bullish momentum has definitely died down. We had this massive rally of dollar strength, but this price action looks much, much different than what we had here. So to be honest, I'm not expecting much more strength from the dollar. And I'm going to be pretty bullish on my dollar pairs, and I'm trying to get in on some long setups. So first try failed, on to the next one.
Okay. Yeah, no, interesting. You guys are kind of on the same side of that, looking for some dollar rollover, looking for Aussie dollar strength, euro dollar strength. Really curious to see how things shape up on that dollar index on the daily chart here. Yeah, it's definitely been in consolidation at these levels. I'd be really curious for bearish looks or bearish setups. To me would be like if we can break that 105.5 level, we very well could see some lower pushes. We're actually having currently the ECB press conferences going on. We'll see if anything comes out of there that could perhaps strengthen the euro, which of course is the largest weighting of the DXY is the comparison to the euro. So if you get some euro strength, that could shape things up a little bit, but we will have to see on that front. What about metals? Gold, silver? Are you watching anything here? I know last time, Miko, you said you were generally speaking more bullish on silver, if I remember correctly. Are you still looking for setups, or are you in one?
Yeah, I'm still looking for some longs on silver. I haven't quite got one yet, but it's taking its time and it's setting up well, so no need to rush. But the idea is that we've had a really big swing to the upside on the daily chart, and I'm looking at this bearish move that we saw over the past couple of months to be a pullback of that for now price to continue higher. And I really like silver because all the higher time frames are still moderately pretty bullish. So it's nice to know that I'm kind of got all of that higher time frame backing in that same direction. So the idea is to find some pullbacks at some point. Not quite happy with the current price action just yet. I kind of want to see a little bit more to the upside because it is pretty corrective now. I like it when we see some really nice strong swings, really impulsive price action, and look for pullbacks after that. So I'm kind of waiting for price to be a little bit stronger on the move up, and then I'll find some pullbacks. I like this level here, so that's probably where I'm going to look to take my buys from. But the idea is to find some entries, expect higher prices, and see if I can trail stops back to the high there, maybe further as well. But yeah, very, very bullish on silver still.
Yeah, and just to talk on gold for just a second, we're sitting right now at a pretty key level of resistance, this 2,700 level. A little bit of a rejection here this morning. I'm really curious to see if gold can break through this high. What I love, and we've talked about this many times, Miko, is the relationship between gold and silver is really interesting, because when gold actually starts to trend, interestingly enough, during that rally that we had in gold this year, some of my best trades were actually longs on silver because I liked the index. In a similar fashion, like the sympathy trades can be really interesting. So like in a similar fashion, like this year, if you were really bullish on the NASDAQ and it's been trending up and away, you might have actually been able to pick some individual stocks or even like sectors, things that actually could benefit even greater from that push. Another example would be obviously crypto, Bitcoin with kind of being the index, if you will, and then altcoins being the more aggressive option. So, there's like with every scenario, there's like the lower volatility options and then the higher ones. So I think silver is sometimes confusing to people because people think gold is more volatile because they trade on Forex brokers, but in actual terms, percentage-wise, silver moves a lot more than gold. It's just that the contract size that CFD brokerages use makes it appear like gold moves more, but it actually, in fact, does not. So in terms of price percentage. Anyways, same question to you, Marco. Are you watching any metals, gold, silver? Or I know you don't necessarily trade them, but for the audience, what are your thoughts on them?
So looking at the daily chart on gold, I do see a pattern which is a bullish one, a V reversal, then a bit of a range, and now continuing up. So if we get the confirmation, and the confirmation would be another leg up, then I would be pretty bullish. Until that happens, I'll of course be patient. And in regards to silver, it's looking a bit more corrective. I'm not seeing any high probability patterns printing, but if silver follows gold, then if I had to give a bias, it would be a bullish one because of this V reversal pattern. But that is about it. The confirmation is still not there. So I would wait for that one more leg up like this.
Yeah. Yeah, and again, gold has had a really remarkable year overall. We've seen a little bit of a stalling out here towards the end of it, but you guys have to remember, for the audience, this is one of the most exceptional years. I think it actually might be the most exceptional performance in the price of gold in my trading time. Up at one point, I'm not sure exactly what it is, but up 30+% at one point here. I'm just going to do the quick, simple math. Yeah, I mean, you're sitting at like a 30+% return right now, 1.36%. I mean, that is an incredible price move in what is traditionally in the finance world considered a really boring, slow, low volatility investment asset. I know, again, people get that, they hear me say that, they say, what? But in actual return percentage basis, it's usually a pretty low volatility asset compared to like the NASDAQ or stocks or things like that. Cryptocurrencies move in percentage form much more than gold. So, just something to think about. Okay, so I also wanted to ask you guys on the currency front for a second about yen pairs. Yen pairs have been really interesting. They've been, a little all over the place. There was this bounce here and things like pound yen and euro yen. Is this a opportunity to sell the rally, or is this more of a straight bear setup? Marco, you got a fire alarm going off or something?
I have someone at the door, so if Miko can take the first one, and then I'll join back.
Don't worry about it. Miko, you've got it. Yen pairs. Is this a pullback play, or what are your thoughts?
Yeah, so I'm actually still pretty bearish on the yen pairs. I still do have a position, excuse me, on CAD yen. I still have stops trailed above this zone here, just above 109.6. And the idea is that I'm looking for a really big swing because I've been looking at the yen pairs on mostly the higher time frames, weekly, even monthly charts. I do think we may have hit a bit of a top of this bullish trend, which is a bit of a bold statement because we've been bullish for like the past 2-3 years. But I do think we could be seeing maybe a bit of bearish trend for a while. And the idea is that I'm looking for swings back to these lows from July, August. We had those big dump in those couple of months there. I'm looking for price to come back to those respective lows. So for CAD yen, I still see a bit more downside. And we have seen a bit of an up move the past few days for the yen pairs, but I'm not quite convinced that that is a reversal. Typically, if I'm looking at a reversal, I want to see bigger, stronger candlesticks to the upside. And then that could give me the impression, if we're very corrective on the way up, I'm still going to be looking at that as a pullback for price to continue lower. And that's the main kind of characteristic we've seen with these up moves. With the yen pairs, it's still really corrective on the way up here. This is pound yen, still very corrective. If I go to euro yen as well, still pretty corrective. As we can see here, still very corrective. So as long as we kind of keep up this corrective behavior, I do think there's still room to the downside. And as I said, looking at a continuation of that big drop there in July/August back to the lows is still very much my plan.
Yeah, no, and I definitely do think that some of the trends, at least that on the fundamental side, that really propelled the the yen pairs higher for quite some time, seem to be changing a little bit. The dynamic seems to be shifting a little bit, where there was inflation concerns and then at some point the yen just kind of fallen out of bed with the Bank of Japan. I don't know, we'll see if any of that stuff kind of comes back, but we had this huge sell-off in August, and during that time we've seen inflation falling globally, so the carry trade unwind was a big concern during that time. But it could be something that's happening maybe in slow motion over time, is just this bit of shift towards yen strength as other central banks cut their interest rates. Specifically, like if we take a look at like CHF JPY, the Swiss National Bank actually cut their interest rate today by more than expected. They're expected to cut by 25 basis points. They actually cut by 50. And so that currency pair you can see is trading lower here today as, the Swiss franc and Japanese yen are both sort of traditionally considered risk-off currencies. But with the Swiss franc offering less of an interest rate, could be causing some weakness there. So we'll see if that trend continues. I do currently have a short position on the Swiss franc by being long dollar Swiss franc. So that one's moving higher today. So that one's a decent trade for me currently. But same question to you, Marco. Yen pairs, you watching any? Are you in any? I know you like to trade Aussie yen is one you like to look at, I think. Or is that right?
Yeah, that's true. I do love AJ. So I did go short on New Zealand JPY at the beginning of the week. Got stopped out just by a couple of pips, and then the price did continue down for a little bit. Overall, looking at the bigger picture, I do see a breakout of this like flat range and now a little bit of a downtrend. So that is why I took a short trade as well. Right there, also saw some nice clean selling price action or bearish price action. In terms of EJ and AJ, well, I am a bit bearish because they are overall moving up in a pretty corrective fashion, just breaking the highs and struggling, which is a telltale sign of market weakness. And again, possibly continuing down with this daily bearish trend. AJ is the final one on my list. And for this one, again, daily bias is a little bit bearish, not as bearish as it was in July, but still kind of overall moving down. I am being, to be honest, more patient. So I think EJ does look interesting with that overall ascending channel. And NJ and AJ are a bit corrective. So I'm being more patient on those. I usually wait for, like, if I'm trading free JPY pairs, I pick the one that looks the best. Then I focus on that. They don't always move the same. The overall trend is bearish on the daily chart on all three of them. But again, just one of them will look good and two of them might look more corrective on the 1 hour chart.
Sure. Yeah, no. And there's times where, everything kind of takes its turn. Sometimes things are moving really solidly. Sometimes things are really choppy. So definitely makes sense. All right. Last one is Bitcoin. What do you guys think about Bitcoin? Back near the highs, trading at 101 currently. Is there more room for this, Miko, or is this looking top heavy? We've been kind of sideways here, even though we've had the huge run up, bit of sideways price action here recently. Are you interested in Bitcoin at all? Are you what are your thoughts on it? Bullish or bearish or just neutral? What do you think?
Yeah, it's an interesting one because we've been flying so well, and now we've started to become a little bit more corrective, a bit more tired, and it's all coming at that 100K mark as well. It looks like the 100K is proving to be a solid level of resistance. I would still say I'm pretty bullish, but momentum is drying up, and because I've looked at prior bullish cycles, and there are times where momentum dries up, and all of a sudden we have a big candle, then we're just back bullish again, which is kind of difficult to predict, at least from using technical analysis anyway. So, the trend is still very much up. There's no significant selling pressure. There's no like big bearish candles that would scare me. So I still think higher prices is likely, but we really need to pick up momentum. If we stay corrective and we stay corrective for too long, then it actually might mean we might actually have a bit of a dip here. But I would still say I'm still bullish. I like what Ethereum is looking, because Ethereum looks like it still has a long way to go back to the all-time high. So I'm still really bullish on Ethereum. Bitcoin's at all-time high, so maybe a retracement is due with that one. But Ethereum's nowhere near the all-time highs yet, so I think there's still value with this one as well. It's an interesting level because it is 100K and where price is stalling. I just don't want it to be corrective for too long. We could be corrective a little bit. It's a healthy part of the trend, but we need to pick up pace soon enough.
Yeah, no, it's been really indecisive. I thought it was interesting you brought up Ethereum as well. So Ethereum's been actually doing really, really well. Had just actually a little bit cleaner price action, I would say, recently than Bitcoin even. Marco, same question. Any crypto you want to talk about? Bitcoin, Ethereum, whatever you'd like. What do you think?
Yeah, let's talk about the two main ones. So for Bitcoin, I mean, this is not that typical. We're kind of struggling to go up. I think Bitcoin mostly has very impulsive legs. Would I say there is a lot of bearish pressure? The only strong bearish pressure I see is in this candle right here. If we go to the weekly chart, I'm sure it's going to look pretty bullish. Yeah, the weekly still looks great. So I'm still very bullish on Bitcoin. I don't think 100K is going to be that turning point. I do think we're going to possibly continue higher. In terms of Ethereum, it's an even better performer. So we are seeing some very nice bullish pressure approaching this major high, but still we have some room to hit that 4.8K. Zooming in, yeah, it's definitely moving more than Bitcoin, which is usually how it goes. So Bitcoin goes first, and then the rest of the altcoins follow a bit later. That is about it. Still bullish on Bitcoin. I don't think this price action is a big concern. Yes, we are slowing down a little bit, but are we printing major bearish legs on the daily? We are certainly not doing that. So that is why I'm still bullish.
Yeah, no, fair enough. I mean, another chart that I just thought was it kind of falls in a similar retail trading fascination category is actually Tesla stock. Just as a bonus chart today, if I show you my screen for a second, Tesla is doing something similar. This made me think when you mentioned that Ethereum has a ways off of its all-time high. Tesla stock is a retail stock darling as well. Huge correction the last few years, and you can see with Elon Musk hype and all the crypto hype right alongside it, Tesla has done some wonder to the upside as well, actually trading at an all-time high as we speak. So just thought that was worth mentioning. There's a lot of hype, a lot of volatility here. And yeah, I mean, I think that when you start to get these kinds of moves where it looks like everybody looks left and they say, well, where can this thing go? This is like a natural spot on a technical chart. And I think that maybe if the crypto stuff continues, Ethereum feels the same way. Maybe there's maybe we're going to see a similar sort of rush up to those highs in Ethereum, putting us back near the 4750 level. I guess we'll have to see.
Hopefully. Yeah. And just a side note, do you know about the Poly Market, like the poll for the election? I think Poly Market was like the biggest site where you could actually gamble on the outcome. And I heard the platform was built on the Ethereum blockchain network. So if that's true, I think that's a big game changer, and that crypto is becoming more and more mainstream, and more websites are going to actually use the blockchain technology to, let's say, spread out their resources so that they cannot be shut down as easily. And
that's really interesting. Another kind of use case for gambling, which of course is a activity that is, different regulations, different options, but with crypto, you kind of get that decentralized concept, etc. So yeah, really interesting stuff. Miko, Marco, I want to thank both you guys for coming on as you always do each week. And we dropped your links earlier in the chat, but maybe we could drop, Chandler stepped out for a second. He'll be back soon, but check this out. There's Miko. There's Marco's YouTube channel. You can find him at Marco's Trading Journey or at Miko Audu on YouTube. You can also find him on social media as well. I highly, highly recommend that you guys do that. If you have not already, take advantage of the free content that they're putting out here. And we will have you guys on, of course, every Thursday. This is a regular show that we do. So thank you guys very much for coming on and sharing your technical ideas with us here today.
Thank you. See ya.
All right. See you guys. Again, yeah, always good to have those guys on. What I love about that segment is that we flip through a lot of charts. And I think that, sometimes I get bogged down talking about one thing for a long time. So having those kinds of shows built in are always fun. So shout out Miko, Marco. Thank you guys for coming on. Make sure, guys, to go support them and check them out. By the way, guys, I also wanted to mention that with the turn of the year, we're doing something fun. Yesterday, we actually dropped for free in our Telegram channel. If you have not already joined our Telegram, make sure to do so. We dropped our forecasts for 2025. When I say we, there's 4 of us on the A1 Trading team, if you will, that are traders. So if you are interested in getting Chris Pulver's ideas, my trade ideas, Frank's ideas, and Ivan's ideas, all of them have just been dropped for free in the Telegram for 2025. If you'd like to get that, make sure to take a second, click the link being dropped in the chat to join our free Telegram channel and get access to our 2025 forecast. Okay, guys, we're going to take just a very short break here. And then up next, we've got Forex James taking over, who's going to be talking charts and continuing the show as our next host. Stay tuned. We will be right back with James just after this.
Hello, everyone doing? Approaching the end of the week now. Basically done in terms of news. Actually, let me just double check that before I say anything. Yeah, pretty much done. We've got GDP tomorrow for the UK pound or the sterling, and that's about it, really. Sebastian, yes, this is live. Just chill. I am here. I will save you from your questions. Give me 1 second. Let me just read what's going on here. His hair gets me every time. Yeah, I went to the bar. Actually, I need to go to the barbers after the stream. I went to the barbers, I think it was a couple of weeks ago, and he's like, "Oh, I like your perm." And I was like, "You what?" That was the most insulting thing anyone's ever said to me. Nearly walked out there and then. All natural, baby. So, Sebastian wants to know, what do you think about the PPI numbers today and year on year? I assume he means you think NASDAQ will go down. Okay, so let's have a look at NASDAQ before we go into anything then. So I assume you trade in New York Open. I trade CFDs, not the futures, so my chart doesn't have the open. However, let me just take a quick look. So PPI came out same on a month-on-month rose. So yeah, I would expect some potential downside movements on NASDAQ, but I don't think it would be anything major. But yeah, overall, I wouldn't suggest the NASDAQ is bearish in terms of the overall trend. Obviously, we are continuing to move up. We've just created a new all-time high. But yeah, some sort of correction would be completely sort of natural here. Something possibly like this. Let me just remove the previous drawings. Something like this would be fine in my eyes. Mo, good to see you. Maybe 1 to 2% down. Let me just see. So we're already about here. I wouldn't say 1 to 2%. I think 1% maybe. I think 2% will be quite a large move. But yeah, I think my main focus, if you're looking to go long on NASDAQ, would be mainly a fill of this imbalance on the left. Is there any advantage of using line chart instead of candlesticks? Yes, in my eyes. So I've actually only recently started using line charts, and it's a lot easier. So I'm not really, I only use these line charts for swing trades. And when I'm swing trading, I don't really pay attention to technicals. I'm more looking at the overall market, the overall trend, and obviously key levels. So in this situation, I actually took a short on Euro AUD last night. I don't care what the candles looked like. I knew that this daily candle was yesterday's daily candle was about to close bearish. We have this level of resistance through here. Morgan Stanley's also short. I'm bearish on the euro, so it made sense to go short. There's no crazy technicals involved here other than the 200 daily moving average. It's right here. It's a bit difficult to see, but yeah, I'm just waiting for that to break and then we'll smooth sail into the downside. And just to, I always like to be transparent, so you can see the open position here. I also pop my FX book on screen as well, so you know that I am worth listening to. So November was a crazy month, actually. This month has been a little bit disappointing in terms of the return. I was up about 4.5%, had to take a little bit of a hit on one of my positions, or a few of my positions. I've managed to climb my way back to slight profit. But yeah, nothing too crazy, really. Standard stuff. So yeah, anyway, sorry, back to the advantage using line charts. You don't get the wicks, essentially. You get the raw price movements. So for example, you might have like a large wick on this candle, but that's not accounted for in the line chart. So it just helps get rid of a lot of the noise that you might see when using candlesticks. Can you share settings? What settings? Settings for what? TradingView MT5? Yeah, exactly. I have a lot of platforms going on, so let me know what settings you want to know about. I'll tell you. No gatekeeping around here. Hello, James. How do you know whether Morgan Stanley is shorting it? I've been looking for investors' reports from them. Loke, I get bank reports every day from all of the large institutions, Morgan Stanley, Goldman Sachs, Credit Agricole, etc., etc. So it normally discloses them in there when they're in positions. What's your take on New Zealand US dollar? I think we're still in for some downside. Today's US dollar news was mixed. So that leads me more to say that the trend is going to continue. The New Zealand dollar is not exactly in a great place to long. And if I'm staying with my overall bias of going long on the US dollar, that means I would then go short New Zealand US dollar. It's now just a case of where do we get an entry? Because at the moment, there isn't really one, especially for a swing trade. So I would love to see a pullback up to these previous highs. But to be honest, with the momentum in this market, the way that we're seeing this develop, it seems like we're just going to continue to run to the downside into this next level of support. So any pullbacks or any significant pullbacks we see, I'll be looking to go short. But yeah, at the moment, there is nothing there. Line chart settings, there isn't any settings for these line charts. Just change here, go from candles to area chart. That's it. NZD is poo-poo. Economic indicators are bearish. Yeah, sure, and I completely agree. Sneaky Snake, I'm good, thank you. How are you? Yeah, we can have a look at gold. Oh, actually, we're having a nice pullback. It might be an opportunity to go long at some point here. So we're seeing a pullback. I spoke about this yesterday. And really, if we're just looking at general zones in this market or general levels, it would make sense for us to pull back or to see a pullback into this previous level of resistance. It would also help price come and meet this 200 moving average. And that to me would be quite a nice entry point to go long from somewhere around here. I would have my take profit at the previous highs, previous all-time highs. Stop loss just below here. This would account for this level of resistance or previous resistance and the moving averages as well. Give price some room to breathe. You still bearish on euro? I am. Yes, we just had a rate cut for the euro, so it just reinforces that bearish outlook. I think they're going to have to continue the rate cuts really the way the eurozone's going. Sebastian, I'm not in a swing on NASDAQ. That was just an example position on what I would be looking for. The only position I have open is the Euro Australian. Pound yen, Swiss yen. Okay. Swiss yen. It's funny, actually. I was saying yesterday that this doesn't look like a bad level to go short. Looking for a complete retracement here. I basically said that word for word, and that's happened. So, you can call me, the algorithm. You can call me Enigma, whatever you want to do. Obviously, I'm joking. I don't fall into those ideas. But yeah, I think overall, Swiss yen is definitely on its way down. The yen in my book is still bullish, although I'm not expecting a huge pump now. It's more a case of it's going to be a little bit choppy and slowly have a sort of correction, at least back up to where it was around here. So in terms of levels, really, if I was going in for a short, I'd be first looking at the previous low and then the next low down here. That's kind of the only two target levels I see at the moment. The daily also has just rejected our 200 moving average here, which is a nice sign. It looks like the weekly candle as well has got a lack of bullish momentum. So if we look here, so far we're failing to engulf the previous weekly candle. So from a technical aspect and from a fundamental aspect, it seems like quite a nice position to be in. We did. Actually, the yen pairs have disappeared off the Edgefinder, but they were quite bearish. So that basically covers all of the yen pairs, to be honest. They're all very, very similar at the moment. The price action is almost 1-to-1. Do you think the Swiss will continue to be strong because of its reputation and stability, even though at some point they might get some negative rates? Yeah, interesting. So we had a rate cut this morning. Yeah, it was just double checking I've got my information right. Yeah, it was the Swiss. So they had a 50 basis point cut this morning, which obviously isn't necessarily great. However, the Swiss is always, in my view, quite a stable currency to buy into. Although in this situation against the yen, considering we just had a rate cut, it makes sense to really go short in my book. Although I wouldn't be shorting now. Again, as I always say, I would be looking for a correction of the move that we've just had that was driven by this this rate cut from the S&B. James in the gold sell already. Good stuff. No, I'm not in any positions apart from Euro Australian. But yeah, I think we might see some short-term downside on gold. Your Euro Australian long. Okay, well, let the best man win. Euro dollar shorts. I agree with that. I actually just got out of a Euro dollar short. Here, just took a quick scalp on this one. Oh, actually, yeah, the positions I left you guys with yesterday. Obviously, I told you I was in some short positions on pound dollar, US dollar. Pound dollar and Euro dollar. So that's how they turned out. Didn't quite get the return I was wanting. It was quite lackluster. But obviously, you can't turn down money. Got to take what the market gives you. Any tips for people looking to trade gold after work? Well, it really depends, what work do you do and what time do you finish, what time zone? Because generally speaking, trading before and after work is probably the best way to do it, obviously, if you can't trade during work. So, for example, where I am, before work, typically, obviously, before 9 a.m., we obviously have a London session. So it's quite easy to trade before work, whereas trading after work is sort of 5 to 6 p.m. when the markets start to slow down because sessions are basically done. So, yeah, really depends. So, first of all, workout. I'm going to be honest, I don't know what time zone GMT +2 is. I'm really bad with time zones. So I would suggest just work out what sessions are closest to your start time and end time of work and try and trade around those. For scalping, what time should I look at right now? I'm looking at daily, 4 hour, 1 hour, 30 minutes, 10 minutes, placing at the 5 minute. I don't think you need all those time frames really to scalp. I'd take the 4 hour trend, the 1 hour trend, and enter on the 5 minutes. Because to be honest, for scalping, you don't need the daily trend. 30 minute is kind of redundant. But yeah, and 10 minutes redundant as well, in my view. You're swinging EU shorts. Good stuff. I think EU shorts have been the easiest trade of the year. Actually, second to the gold long swings that people could have caught. EU shorts have been pretty brain dead. My trades are always market executed. I don't like limit orders. I like to assess the markets before I get in. So, for example, I don't want to enter if the market's got really strong pressure, a counter to where I'm trading. So I like to enter off an engulfing candle. Ideally, obviously not in every situation, but generally speaking, I won't set limit orders. Sean, I completely agree. This is why I don't like scalping on low time frames. The lowest I'll go is the 15-minute. So for anyone that doesn't know, this is a little bit of a tip for you. If you are a scalper and you're trading the 30-second, the 1 minute, the 5 minute, or anything sort of lower than that, you'll get a lot of what is genuine just noise. It's a lot of corporate wallets, hedging accounts, swapping over currencies, and it's not speculative trading. So trying to trade a lot of that movement is next to impossible. Unless unless you have some sort of crazy algo that's high frequency, but generally for average retail, it's pretty impossible to do. especially sustainably. Your thoughts on Swiss monetary policy? I think it's quite a dovish tone, really, or a dovish move, I should say. Doesn't look very hopeful for the Swiss, although, again, I think the Swiss is always going to be quite a stable currency, so it's not something I'm going to be a super bear on, but it's not something I would want to buy either. Well, 2 hours ahead of London at the moment, so didn't finish work until 2 o'clock London time. If you're finishing at 2 o'clock London time, then you get home, well, I would assume if it takes you half an hour, you'll get home for sort of New York ish. So I would look to trade New York session, really. Why skip pound yen? Because the yen pairs are all very similar. So I can say what happens on one pair is basically the same as the other yen pairs. So we, again, we've had almost a full fill of this move. Still looking for overall a bearish continuation on the yen pairs, although pound yen might be a little bit different with the dollar yen. The pound seems to be holding its ground a little bit more than a lot of the other G10 currencies. So I would really like to go short overall. Actually, let's have a look on the H4 here. Yeah, similar thing here. We've got a rejection, well, or what could be a rejection here of our 200 daily moving average, which for people that don't know is a good indicator of, it can be used as dynamic support and resistance. So it's good to pay attention to. Here, failure to hold above our 200 moving average on the H4. Continued move to the downside so far. So yeah, pretty similar to the other yen. USD CAD. I'm really tempted to go long on dollar CAD, actually. I was tempted to just take an aggressive entry. I think it was around here on this first bullish candle. I didn't do it because it's not really in line with the way I trade. And I don't want to get into too many positions before Christmas. But I think dollar CAD is pretty, it's pretty straightforward, really. I mean, look at the weekly momentum to the upside. We've got the daily chugging along. We've got the H1 that's bullish. The H4 is bullish. The dollar is very strong. Canadian dollar isn't doing too hot. And again, it's quite likely we're going to have lower oil prices into 2025. So I would be looking to target these next highs around here. That's sort of my profit target. The Edgefinder shows retail sentiment for USD CAD is bearish, so bullish would be the right move. Yes, generally speaking. The funny thing is with the retail sentiment is sometimes they're right. So it's not a case of always trade against retail. It's more just if they are against you, it's a good sign. If they're with you, but everything else is also with you, then it's still, in my eyes, a fine trade to take. It's a bit like an indicator rather than a full trade idea in itself. Yeah, it's still not really having enough of a pullback on these indices. Love NASDAQ to go lower. The Nikkei is now the top setup on the Edgefinder, actually, for a bullish move. Although this weekly time frame doesn't look very convincing. We've got a really strong resistance line through here. Yeah, it's not ideal to buy into, I don't think. So if I was going to buy the Nikkei, I think the ideal situation really is to pull back into this 200 moving average. Buy here. This is also lining up with quite a nice support level through there. Wait for a break and then retest. So you could get an entry here or an entry on this retest. And that's kind of the only two situations I see this as a valid position in my eyes from a technical standpoint. Hi James, what positions are you currently in? Just Euro Australian here. So I entered on the daily time frame. So pretty straightforward, really. So the daily broke out of our Bollinger Bands here, and then the yesterday's daily candle closed bearish. So decided to take a short, the stop loss above the daily highs, take profits at the daily support. So yeah, again, a very straightforward trade, nothing too crazy. Basically just following Morgan Stanley and capitalizing on the weak euro. Although the Australian dollar is not necessarily the best asset to do that against. However, it's in the right sort of price range to do that. So if you look at a lot of the euro pairs, they're all quite extended to the downside, whereas euro AUD isn't quite in that same situation. So I think there's still some room to the downside. I use the 50 EMA as well as the 200. So, sorry, I'm just going to take a drink here. I've got a dry throat. There we go. Okay, cool. So yeah, the yen's not having much success in breaking higher, which is a bit disappointing. Euro and the pound continue to move to the downside. It should be the DXY. DXY still continue to move up. I'm still looking towards the 110 level. That's kind of the target. And if we can break above 107 and hold above, I'm going to get really heavy into dollar longs. Depending on the situation with the euro at this time, it will probably be very heavy euro dollar shorts towards parity. That will be sort of my final confluence that euro dollar is going to continue down. Golden and death crosses. I'm not sure what that means, to be quite honest, Harry. Sorry. Feel free to enlighten me. So Fed Watch is essentially 100% priced in now that we're going to have 25 basis point cut. And I had someone ask me this morning, why is the dollar moving up if the Fed's cutting? Now, I've explained this before. So for anyone that watches my segments quite often, and I'm sorry, I'm going to sound like a broken record. But the idea of a Fed cut being bearish and a Fed hike being bullish isn't quite as simple as it sounds, because what we often have is a long period before we get the Fed decision of pricing in, which you can see here. When we had the, this was when the labor market was deteriorating quite dramatically. It was also quite clear to investors that we were going to get a 50 basis point cut. Then we had our 50 basis point cut somewhere around this period here. I can't remember the exact date off the top of my head, but we did have it. And then the market consolidated. And then we actually started moving up on the back of better US labor data. But the point is, just because it's expected the Fed is going to cut, it doesn't mean the US dollar is necessarily going to start dropping. GBJPY analysis, sir. I stuck 192.4 on sell. What should I do? As I say to everyone, and this isn't personal, but if you're coming to a stream to ask what you should do with one of your trades, you should probably not really be trading live capital, because it tells me you don't have a strategy for drawdown or risk management. So you're at 192.4. You didn't tell me where your stop is, which is interesting, if you have a stop. To be honest, you're pretty close to entry. So if this was my position, I would just hold it. Or if you're in, if you've over risked and you're in a deep drawdown, then just accept the loss and move on. Take it as a learning lesson. But yeah, generally speaking, I don't really see too much wrong with this at the moment. Nicknames for 50 and 200 crossing on daily timeframes. Oh, Harry, I see. Yeah, I get it. I had a feeling you were talking about the EMAs, but I just wanted to be sure. Yeah, it's funny, actually. A lot of people mock EMAs. It's like, oh, retail use moving averages, but that's not really the case. There is a lot of institutions that do use moving averages, and these crosses are actually very accurate for determining, but helping to identify what the trend is. I missed the gold idea for trading it after work today. Do you mean you missed your trade, or you missed what I said about it? Yeah, gold's just dropping, which is really nice to see, actually. We'll see if we can get some sort of entry here. Let's get these off. So for gold, what do I want to do? Actually, we need to go on to the H4. Yeah, pretty simple. I just need to see it pull into this level of previous resistance. That's it. If we can do that, I'll take an entry. Yeah, we'll see. We'll see what happens. Some insight into why gold's bearish, because the dollar's moving up. Really, there's nothing that's driving gold individually at the moment, in my opinion. So when the dollar's moving to the upside, gold is going to have a reaction to that. And the situation where gold and the dollar move up is normally when there's some sort of geopolitical crisis going on. There's something that is driving both of the assets individually, and it's causing the XAU USD pair to move up as well as the US dollar. Moving averages and standard deviation, etc., even quants use its math and price movements and time momentum. I can tell you a lot of these. You need to have your own strategy, blah blah. John Stock, I think we could be friends. How do you know gold will drop to that level? Maybe it'll stop here and go back up. This is what confuses me with gold. Paul, that's a great question. I don't know anything. I don't know what the markets are going to do. I have an idea. So, for example, euro dollar, I have an idea it's going to go to parity, but I don't know that for a fact. So with gold, why I'm saying this level specifically is because it's the next level that I'm interested in trading. So if this level isn't hit, then I don't want to trade it. So for example, if we just stop here and then we start going to the upside, then I'm not in the trade. I don't care because it's not what I want to be in. Whereas if it hits the support level that I've drawn up, then I'm interested because at least we've got something there that backs up my long idea. Even though it's just a small technical level, it's still something. So that's basically it. Can you help James to understand Fed and interest rates? Why Fed expected to cut in December while we have 4 months of sticky inflation? Because it's just expected. That's just what is the situation. I don't really, I'll be honest, I don't really know how to answer that properly, because it's the whole economy is tied to what the interest rates are essentially. So it's not, obviously, individual cases are different. I'm talking from a broad view here. But inflation isn't the only thing. We obviously, like I said earlier, we had very, very poor labor market data, which was also contributing to the Fed cuts. But if you've been listening to what the Fed has been coming out with recently, it sounds quite positive in terms of the fact that they're happy to slow down the rate cuts. So yeah, I wouldn't. This is going to sound a bit a strange thing to say, but I wouldn't focus on it too much. More than reacting from what the data comes out as, if that makes sense at all. Hi James, EU is going to parity. Question is when. Yeah, I think we had this discussion yesterday. I think you said it's not going to be. Oh no, we were talking about support level, weren't we? I can't remember. Anyway, yeah, I think it's definitely going to parity. I shouldn't say definitely. My opinion is parity is inevitable, and that's just accounting for the fact, or assuming from the fact that Eurozone data doesn't start improving or the US dollar data doesn't start worsening. If the economics stay as they are, there is nothing stopping parity coming into play. And I think the worst, well, actually, I think the best situation for euro dollar to start heading higher is if we get that ceasefire with Russia-Ukraine. Although that doesn't seem likely, and I'll tell you why very briefly because I covered it yesterday. But the reason why the Russia-Ukraine ceasefire doesn't seem likely is because Trump was the one that basically instigated it, and the only premise it was based on was that Russia would essentially keep the land that they have already taken from Ukraine, and Ukraine obviously doesn't want that. So Zelensky basically said it's a no-go. I think, obviously, I'm paraphrasing, I'm dumbing it down, but essentially that's the situation. So a ceasefire doesn't seem like it's on the table at the moment. First time seeing this channel, great stuff, logical, patient trading, big up from the UK. Ryoki, I'm in the UK too. I appreciate it. This isn't my channel, but obviously I'm a guest on here, so it means a lot to me that you like it. I'm going to be honest. I'm going to say it is the Shriek family, but I apologize if I got that wrong. Thank you for that. That makes me smile. So let's see what's going on. Let's check on this position here. It's frustrating. It is what it is. Thing is, yesterday I was sat here and I was like, I can't wait to get out of my positions. I want to be flat for Christmas. And here I am in a new position because I just couldn't hold the trigger finger. And it's fine. Obviously, the trade in itself is fine. There's no problem with it. It's just maybe I maybe shouldn't have taken it. Not for any reason, not because I don't think the trade is going to work. Again, it's just because I wanted to be flat for Christmas. Now I'm going to have to likely hold one through the Christmas period. Also, I saw that Australian US dollars reached a very low point. When was it last here? 2023. Interesting. So, yeah, I'd love to go short on these. The problem is, I'm just very cautious now with a lot of these dollar pairs. We're very extended. I mean, look at US dollar CAD, very, very extended. Euro dollar, it's kind of range bound at the moment. Still got some bearish momentum, but it's still very extended. The dollar NOK, very extended. It's the same situation for a lot of these dollar pairs, or even all of the dollar pairs. So I'm just very hesitant to get into any longer term positions. Okay. Although, wouldn't be opposed to going short on euro dollar again for a short term DCA day trade here. Possibly. I'm going to mark this up around here. We'll see if we can get an entry on euro dollar actually on stream. Move this down a bit. We'll see. Maybe. Zoom out, look at the monthly, go back in time. Euro and USD are long-term range bound, and it's an inception. Look at Euro futures 6E1 on TradingView CME. Euro came into existence in 1999, 2001. It's currently hovering to key level. Yeah, that's another thing. Euro dollar is a very strong level, but again, as a fundamental trader, it's more a case of when is the key level going to break, not a case of is it going to break. So if we look on this weekly here, when was the last time we were at parity? 2022. Yeah, I just don't see any world where we don't break this. I was supposed to close all trades this week, and I'm still marking levels for buys or sells. Yeah, Adam, I'm in the same situation. I know I should be closing down. I'm going away tomorrow, actually, so I'm going to have to stop trading. But it's very difficult to not at least look. And obviously, sometimes it's not the right approach, but what can you do? This is my job. It's what I love to do. Poll for the room. What's your average risk to reward per trade? Actually, that's a good question. Let me see. Mine is 1 to 3.4 on my profit factor here on on my FX book. So for every 1% I risk, I think it's a 0.3.4. Something along those lines, but it's positive, which is fine. But I'll be honest, and this is a little bit controversial, especially in the retail space, but I don't really believe in risk to reward. I think it's a little bit of one of those things that's been spread and said by so many people. It's now just accepted as a gold standard, whereas I don't really see that as the case. So, for example, why would you have $1 million in a trading account, but only risk 1%? Because then you could just reduce your account and risk 10% for the same thing with obviously margin. it's capital that is sat doing nothing. And there's a good trader actually called Trader Tom. I'm sure you guys know him, or you'll at least know of him. He's a very, very good trader, and he introduced me to that idea, and it was a bit eye-opening actually. Has Dow been whooping everyone's asses, or just me? Well, yeah, not me, but it's been a difficult one to try and gauge, really. I actually don't mind where the Dow is right now. We've had the pullback, almost this 200 moving average. We've filled this gap. We've still got some imbalance around here. That's a little bit of a warning sign to me. But let's actually see. Is this actually, you know what? If we could come down slightly lower, actually, I'm just going to redo that. If we could come down slightly lower to this 50% level, so somewhere in between this fib zone, that would be a perfect entry. So we've got our 200 moving average here to act as dynamic support. We've got a minor level through here. It's nothing overly strong, but it's enough in my book. So this wouldn't be a bad buying opportunity as far as I'm concerned. Again, this is just looking at technicals. It's not reading on the Edgefinder as bullish or bearish. So that's probably not something I'm going to take. But James, that is what I do. Just deposit less money and risk up to 10%. Yeah, that's the thing. As I've been DCA trading a lot more recently, it's changed a lot of the way I think. And this is the thing. I think there's this big misconception in trading space. You'll find this specifically with a lot of the gurus. They'll have one way of trading and they will not accept any new information. They will never try and learn anything new. And this is obviously regardless of if they're profitable or not. But I think a key thing to growing as a person and a trader is always trying to learn something new. And that's what I've taken away from this year is, first of all, I lost a lot of money trading the yen back in July, August time because I was very over leveraged. I was way too married to my bias and it cost me a lot of money. So that was the first learning lesson I made. And the second one this year has also been my risk tolerance is actually a lot higher than what I thought it was, which obviously still needs to be managed. I'm not saying that I risk 20% on a trade with no stop loss. That's definitely not what I'm saying. But what I mean is obviously I have a capability to risk more if I manage my risk in a slightly different way, depending on the trading style that I'm taking on that particular one. Anyway, kind of went on a yapping fester. Oh, Sean, you're in the UK. Good stuff. It's miserable today. Well, actually, it's been miserable for the past couple of days. Well, it's miserable all the time, actually. You're not risking 10%. You're still risking 1%. Just because you don't have all your capital in the account doesn't change percentages. Kyle, it does. If you're risking, let's say you've got 100,000 in your account, you're risking $1,000. Then you reduce your account to 10,000 and risk that same 1,000. That's 10%. It's not 1% because if you're risking 1% on 10,000, that isn't $1,000. Sean, I completely agree. Things are definitely turning sour here. It seems like we're not going to get a new government anytime soon. Keir Starmer threw that petition out of the window, essentially. It's very depressing here, which is why you got to make the most of it. But there you go. Euro dollar, yeah, moving up slightly. I'm very tempted to take a short position. We'll see. Maybe not right now. I'll think about it. We'll sit on it. Yeah. Anyway, let's get back to the markets. So dollar's actually lost a little bit of strength here. Euro's gaining some strength, nothing too major. Yen's pretty flat. Pound is pretty flat. Nothing too interesting. Dollar CAD has actually pulled back to where I'd want to enter. But again, not really wanting to get into a swing trade. Now, dollar yen. I actually think dollar yen might start having some upside movements. contrary to what I was saying before about a lot of the yen pairs being bearish, I think dollar yen is probably the one that is primed to go higher. So I would possibly look to go long. And if I wasn't slowing down on my trading, I might actually take this trade just back to the sort of the previous highs around 156.455. But, you know, we'll see. And again, that's more based on, yes, I'm bullish on the yen, but not in the short term. It's more of a gradual strengthening of the yen that I'm looking for rather than anything too immediate. So capitalizing on just dollar strength in this market might be enough. Silver. Yeah, we can have a look at silver. Let me just catch up with the chat. Lee says it's December. It is December, but during summer we get like maybe 2 weeks maximum of sun, and that's about it. All of us here in London share the same sentiment about the weather and comfort. Yeah, I'm so glad I got out. Actually, yeah, I'm glad I got out of London, but I really miss all the delivery services. There's been so many times on a Friday night where I've sat thinking, oh, I could really do with going to this restaurant or ordering from this place. I can't do it anymore because obviously I don't live in London now, so it's a bit sad. I miss my places. So let's have a look at silver. Oh, this looks really good. I really, really like silver actually, where it is. This is a strong technical level. We've just come into these 200 and the 50 moving average. A nice bearish candle that could see some correction here. It's basically what I was looking at on gold, but it's actually happened. It's looking a little bit early to go in long right now, but I think if we can hold basically where we are, I think it would be quite a good opportunity to get in a long position here. A lot of peeps in here maybe A1 need to do London session. That would be interesting, actually. I don't think there's any streams that are worthwhile watching during London session. I'm up normally about 7:30 to 8 o'clock UK time. And I'll have to sit on the charts just watching normally Billions or Suits or something because there's nothing trading related that's worth watching. Hey James, any thoughts on Euro Pound? Yeah, Euro Pound's definitely worth watching, actually. I've not spoken about Euro Pound in a while. However, the UK data seems, I wouldn't say strong, but it's definitely not weak. And where the GBP isn't in as bad of a situation as the euro is. I've also seen quite a few reports saying that Euro Pound has a lot more room to go to the downside. So I'd be quite happy just taking a short, basically, if we can get a retest on this previous support level and continue down. The problem I have is there's not really any levels to target. So unless you want to go for something huge down here, so this would be a almost 600 pip move, which is a lot, obviously, on this pair. Then the only real way to do this is have a hard take profit at a 1-to-1 or a 1-to-2, whatever, or trail stops. It's the only two ways I see this trade being able to get managed properly. Again, because there's not really any structure to go off in terms of a profit level. Except for our new streams, Sean. Maybe. Possibly, yeah. I would love to do more streams on my own channel, but to be honest, finding the time. So I honestly do not know how Nick does it. I don't know how he trades, runs a business, streams, and has a wife. I just don't get it. All I do is trade and run a business from the same desk. And every day it's just a fight for time. Euro Pound trades in a tight range, highly correlated. Yeah, that's another thing. I've been wanting to go short on Euro Pound for so long, But the way I trade swing trades, or my entry criteria for a swing trade, is very specific. Well, actually, it's not. It's not even that specific. I just need a 50% pullback with some previous structure, and that's it. But euro pound's price action is just so ugly. It's very it's almost impulsive in terms of we get very strong moves to the upside and then a gradual return back, strong move to the upside, gradual return back, strong move up, gradual return. And this might be a similar situation where we're having a strong move up and a gradual return. And if that is the case, might take an entry. But yeah, we'll see. Have you watched Industry? I have watched Industry. It's a very good show. Can you check euro dollars? Giving me palpitation. Yeah, I think euro dollar's pretty ready to come down. Actually, I'm going to take a short. We're going short here, one lot. Don't follow. That's not a signal, by the way. This is what I would do anyway. It just happens I'm on stream. Euro dollar was bullish in Edgefinder. Cedric, this is one of the very rare cases where I'm not following the Edgefinder because the overall macros for euro dollar, in my opinion, are very, very bearish. Nick doesn't sleep. That's how. It wouldn't surprise me. He's probably a vampire or something. That the trailer he did for Halloween, it's probably just Nick showing his true self. So yeah, euro dollar. I'll set to take profit just at the previous lows. We'll see how that goes. I'm going to set a pending order as well here. So we'll leave that there. See how that goes. But yeah, I think there should be some more shows based on trading. I think the only one that's been like highly produced really was Billions, and Industry was good, but it's not really entertaining enough to go and rewatch. It's more just about a crybaby trying not to lose money. Anyway, again, went on yapping. Apologies. I know you guys come for charts, and it's my segment comes, and it's more a lot of talking. So, hope you don't mind. Landmark Dan $1 Million Show. I'm not seeing that. You know what? Actually, the other show that's really, really good is the one by Anton Creel on BBC. I think it was BBC. I think it was called $1 Million Trader or something. And that's just taking average people off the street. I think they had like a shop worker on there, like a corner shop guy and some other people. And they teach them how to become stock traders. That was a good show. That's worth watching. But yeah, other than that, there's not really much. So let's have a refocus here. Not really interested in too much here, actually. Euro AUD is pulling back. I'm not too happy about that, but what can you do? Oh, Euro CAD. I was discussing this one. I think it was a couple of days, maybe at the start of the week, I was talking about going long on Euro CAD. I said I didn't mind it. And unfortunately, I'm not in it. But so far, it looks pretty positive. Yes, you talking about, that's the one, its name is something like it. Yeah, okay, it is the $1 Million Trader by Anton Creel. It's also got the other guy, I've forgotten his name. Someone, what's his name? I can't remember his name. Very, very good trader though. Can we look at GJ? Yeah, let me just check on time. Don't want to run into someone else's time slot. Okay, so I'm on for another 15 minutes, and then you've got Chris. So yeah, we can have a look at pound yen. So yeah, I think you know what? I'm going to change what I said earlier. I think we're going to have some more upside actually on some of these yen pairs, and then we're going to be starting to go down. And I know that sounds a little bit unhelpful, but just looking at the way the yen's been moving, excuse me, looking at the way the yen's been moving the past couple of days, it just doesn't seem to have any momentum left. So it's possible we start coming back down to previous lows or previous levels of structure. Could be anywhere. But yeah, it just doesn't look like it's got enough steam to really start driving these markets lower at this time. So yeah, I'd be quite happy to say we might see slightly higher prices before we see yen starting to strengthen anymore. Lex Van Dam, that's the guy. Yeah, very good. EU is flying. It is. Second entry point might be on the way. That's fine. What do you think about Australian dollar, US dollar? Yeah, I think we're going to continue to see downside, really. Australian dollar's not as weak as some of its peers or other currencies, so it might have a little bit more difficulty breaking below the support level. But generally speaking, I think in the long term, so over the next couple of weeks, I think the US dollar is just going to continue to strengthen, which will eventually drive this market lower. So we'll see. ITPM, Lex Van Dam's best out there for retail traders to get educated in real trading. Yeah, it is. I was very tempted to join ITPM, actually. I've got another mentorship coming up this year, though, in February. So I'll be doing that one, and then might consider ITPM after that. Check financial juice for euro. Let's see. I don't condone pirated courses, especially from real traders. I think when you pay for a mentorship, you're not just paying for the video stuff, you're paying for that person's one-to-one input and their experience and that sort of custom approach. Yeah, IG Boss. I think one of the best things retail traders can make is getting mentorship. Mainly from either professional, industry professional traders, or at least people that can show you results. Because otherwise you're fighting a losing battle, really. Traders pair ECB easing bets, but less than 125 basis points 2025. ECB forecast inflation easing 2%. That's fine. Doesn't really bother me, to be honest. Still short euro dollar. I'm from India. It's like 2 years salary. What do you expect? In that case, I see it's a little bit more acceptable, I guess. But yeah, it's difficult, really, because I was thinking about this the other day. Like, I complain a lot about the UK and the way things are going, but at the end of the day, I'm still very fortunate to have been born in a first world country where, certain things aren't a huge deal in terms of finances, even for the average person. So yeah, it's just one of those things, unfortunately. How do you get a mentor? Do you have to pay? Yes, Michael, for a good mentor, you'll have to pay. Or the other option is you can go on to somewhere like LinkedIn and you can find someone that doesn't actually offer mentorships. So someone that doesn't have a company like ITPM or like Elite Traders or A1 Trading, whatever it may be. Find someone and just tell them, you want to do this, you're very dedicated, you'll do whatever it takes, but in return, you want them to help you and teach you and mentor you. And that can work. That's basically how I found my first mentor, but I already knew him for a family friend, but essentially that's basically, I helped him with some marketing and design stuff. And he gave me some mentorship type stuff. Oh, that's disappointing. No second entry right now. Who is your first mentor? I'm not going to say his name because he's not an online person. Again, he was a family friend. So I have my uncle, that knows quite a few people. He's quite big in a certain industry, not in finance. It's a completely different industry, but he had a friend that worked in finance, so I got in contact with him. So that was more, again, you know, I was again quite fortunate to have that opportunity, but not. If I didn't have that, I think I'd be in a very different place right now. I think my monitor just turned off. I had this problem yesterday. The plug for my monitor is right underneath my deck. Damn, my bad. Sorry, it's back. So what I was saying is, just before I go, I don't know when I'm going to be back on this stream. I don't know what the A1 guys are doing. I don't know what I'm doing. So if anyone does want to join Elite Traders, now is the time to do it. We currently have a 25% off code that lasts forever. So if you pay 25% off, you get 25% off continuing. So yeah, that's my marketing done for today. So I don't think there is anything in terms of the charts. See what Nasdaq's doing. Is it pulling back enough? Slightly. Definitely not to where I'd like, though, which is a bit disappointing. I read there's a possible rate increase by Japan. What influence will it have? Anton, that's a good point, actually. I covered this yesterday, but I'll cover it again for anyone that wasn't here. So there was a big, well, not big, but there was a couple of people I saw on social media that were talking about this move, this bullish candle we had. And it's manipulation, it's liquidity sweeps, it's blah 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 blah, and it's not. So what caused that move? I'm gonna have to find where it was actually, but it was essentially the Bank of Japan made some statements that were a little bit mixed, more to the positive side, but it was more positive for long term rather than an immediate thing. So what they said was there's little cost to waiting for a rate hike. So that tells us, one, they are going to hike rates, but two, it might not be in December. Although some BOJ officials said they're not against a rate hike if it's proposed. So again, that's positive, but it's not anything definite. And that's what caused this move. It was essentially a knee-jerk reaction downside, and then it continued up. If they do hike rates, there is currently a 40% expectation the Bank of Japan's going to hold. There's a 60% expectation they're going to hike. Now, if they do hike, I wouldn't expect it to be. Actually, you know what? I'm going to say I think a hike would obviously be a good thing, but I think that would really support the yen's continuation to the upside. Whereas if they hold, I see that actually as quite a bad sign, because I think investors really do need to see the Bank of Japan do something, because at the moment we're just going to head back to the lows that we were at previously. Eric, the 25% off will be removed on the 1st of January. So from now until the 1st of January, that code will be active. And obviously, if you use it before January, the code will last on your account. So you're not going to get charged more. But obviously, we remove the code from public use. Hike is bullish for yen. We'll see more currencies giving up to the yen. Sean, exactly. Yep. Although it's not sounding very positive for a hike. Khalid, I use a similar platform to A1 Trading. I'm not going to say it because I think that'll be unfair. But you could say, just typing on Google central bank probabilities, and I'm sure you'll find something on there for free. But yeah, I'm not here to advertise any services apart from my own and the A1 Trading stuff. because obviously this is the A1 channel. No, I don't want that. I want MetaTrader. There we go. Almost a pinpoint entry, but it looks like MetaTrader's frozen, so that's great. So far, so good. Might be able to trim some profits off this pretty soon. 5 minutes left. Now is your chance. Any final questions? If not, I'll keep rambling for a little bit. CME watch, if you want to know about. Yes, if you want to know about Fed movements, CME. Oh, it's the wrong tab. The CME watch tool is 100% free, very easily accessible. So let's have a quick look on the Edgefinder. We've not done that actually this stream. I normally go over what's on here. So we've got the Nikkei is the top reading. We've got Nasdaq, copper, platinum, gold, euro, dollar, and dollar ZAR. The only one I'm really interested in though is the Nasdaq. I don't like where the Nikkei is on the weekly time frame. I've already had a trade on copper, so I made some money on that. I'm not looking to get back in. Nasdaq, gold longs might be interesting. Let's go back and have a quick look at gold. Seems like we're losing a little bit of the selling pressure here, which I don't really like. So because gold's on the Edgefinder on a bullish reading, I think I'd be quite happy to go in long from here. But if we don't get that, then there's no trade for me. Euro dollar longs, I don't like that. I'm going to stay short. And US dollar ZAR, don't trade the ZAR, so I'm not even going to bother looking at that because I don't know anything that's driving it. Liban, hello, good to see you. Does using a stop loss delay your progress in trading? No, definitely not. Using a stop loss is, unless you have someone that can guide you how to trade without a stop loss, you are going to blow your account. It's essentially trading 101, how to blow accounts. Don't use a stop loss. Now, I don't use a stop loss on some of my trades because I understand how to manage my risk and what lot sizes to use and what to do in each situation and how to get out of a drawdown in certain situations. But again, that's through experience. That's through learning from other people. The first time I tried to trade without a stop loss, I lost a lot of money on US 30. And that was a big turning point in my trading journey. So yeah, use a stop loss. How do you calculate lot size on a 100K prop account? Do you calculate it from your initial or MDD? I always use my risk on my balance. So I don't use equity risk. So for example, I'll show you here. Oh, actually, I can't. MetaTrader's frozen. But there's a tool. If you're using MetaTrader, you can just Google it. It's just a risk calculator tool for MetaTrader 4 or 5. And you type in, well, you select, do you want it for risk on your balance or on your equity, or, well, that's it. And it'll give you what lot size you want. So prop firm calculators based off risk amount. Yeah, there's so many ways to calculate your risk. Or, just go in with 100 lots and hope for the best. I mean, if it's a prop account, it can only blow or pass. Okay. Yeah, silver's not really slowing down, so we'll scrap this idea. We might see, well, if we see some sort of wick rejection to the downside and the candle close back in this level, then I might reconsider. However, the way the market's moving right now is very aggressive or very volatile to the downside, so I'm not looking to take that. If 500K, then 5K is your max risk, assuming 10%. That's lots based off 5K. Yeah, this is another thing actually with prop firms. It's very it's kind of misleading, really, because when you buy a 50K or 100K account, obviously it's a sim account anyway, but you don't actually get 100K because of the max drawdown and the daily loss. Your account is like 5K or 10K, like Sean said. So it can be quite misleading, and it can be quite difficult really to work out the correct risk. Sim account or simp account? It's funny. I saw a guy on Twitter. I think I retweeted it or requoted it or something. It was a guy that made a love song for one of the prop firms, and I was just thinking, oh my god, because in the song he said he's not had a payout yet. Like he wants to get one in 2025. I was just thinking, if you have time to make a love song for a prop firm, you should probably spend that time doing something else. And this prop firm is not giving you any money. So I was just a little bit perplexed by that one. But anyway, guys, my time is done here. I'm a bit sick of you all, so I'm going to go and, I don't know, I might play some chess. So I'm joking, obviously. Guys, thank you for having me. You've been great, as always. I'll probably see you again next week if there is some streams on. If not, have a great Christmas. I'll see you all later.
'Twas the night before Christmas, and all through the house not a creature was stirring, except Chris Pulver, apparently, who just took a trade on gold. It's the middle of the night. I'm not really sure how he did that. Pulver alerts are now available at A1Trading.com. Get exclusive access to Chris Pulver's trades with A1 Trading's Pulver alerts. Watch as Chris Pulver, a seasoned trading pro, navigates the markets, manages risk, and applies a disciplined trading process. Join today to level up your skills and learn from Chris's wealth of experience. Get Pulver alerts now.
Good morning, everybody. Happy Thursday. Screen share is coming up right meow. How's everybody doing today? So, interesting day. We had some more inflation readings, and guess what? Inflation's higher. Guess what? The market's kind of reacting to the reality of like, oh, wait a minute. I would say there's some heavy amounts of manipulation going on yesterday to today, right? Market got real excited about that move with no real data to support it. We just ripped higher using CPI as potentially the catalyst, and the market's headline says benign, which it really wasn't. It was higher. Anyway, markets go up higher yesterday. NASDAQ make all-time highs. That was the headline as we crossed 20,000 for the first time. We've crossed 20,000 by a pretty big amount. SPY just shy of the all-time highs. And what are we doing today? PPI comes out. We're fading that move. We're right in between, right? We have a gap from yesterday's close to today's open. We have a gap from CPI yesterday that the market is kind of tapping into. I'm not sure if the market is going to be filling this gap, but I asked this question earlier in my session. Would this surprise anybody to see this type of price manipulation, to see CPI push everything up, PPI, or just market reality pushing things down? And all it is just a lot of price manipulation. But overall price doesn't actually go anywhere. Okay, you heard me. Right meow. Okay, so anyway, where are we for the week? Well, we're still red on the week because we started off back-footed on Monday, and we're right back where we started for Monday's trading. Now, obviously, there's a lot of chop to go from lows all the way up to the highs, back to the lows, or if we go from lows to the highs and we settle somewhere in here for the rest of the week, that's price being price. We come into next week with the Fed. Is the Fed going to be able to drive price higher? Are they driving it lower? Are they driving price anywhere? It's the last full week of trading, right? So if we look at our calendar here, this week's trading to next week's trading, this is it. This is the last week of trading with the Fed. Fed on the 18th, okay? It's now like a 98% chance they're going to cut rates. I'm just going to show the data here. I think this is interesting. Okay. So if we go into the watch tool, 98.1% chance the Fed is going to be cutting rates next week. That brings us down a full 100 basis points since September. We go to inflation. Let's take a look at our previous and last print in some of our currencies. So Australia, Canadian, Swiss, Euro, Pound, New Zealand, dollar. So let's start in alphabetical order. Australia, previous print 3.8. Australia is the last print was 2.8. So Australia, I'll type this out. I did this for my session earlier. Australia, I'll just type in the currency pair so I can do it in alphabetical order. So CAD, Swiss, Euro, Pound, New Zealand, and dollar. All right. So which way is their country headed as far as inflation goes? According to this, Australia 3.8 printed 2.8. So Australia inflation is trending lower. Okay. Canada Canada 1.6, last print was 2, higher. And the BOC just cut by 50 basis points, didn't they? The Swiss, we got to go all the way down to S's for Switzerland. Switzerland, 0.6 came in 0.7, 1/10 of 1%, but still higher. How about the Eurozone? Okay, you can go to all these different countries. Germany, 2 to 2.2, that's higher. Go to the European, I was going to say Euro area, Euro Union, 2 to 2.3, 2.1 to 2.3, higher. So inflation is going higher. The Eurozone just cut by 25 basis points today. The Swiss also cut 50 basis points today, which was a nice surprise. Currency strength. Nice little reaction right out of the news this morning. Swiss is our weakest currency pair, which I'm obviously happy to see. Got a nice little P&L swing in my currency pairs. Let's go back to inflation. Where are we at? UK. UK 1.7 printed 2.3 last. That is trending higher. How about Japan? Japan 2.5 printed 2.3. Japan's actually trending lower. New Zealand 3.3 printed 2.2. That's the last print, so they're trending lower. And dollar, we just saw it today. CPI yesterday, PPI today. US is trending higher, 2.6, 2.7. Okay, so CAD higher, Swiss higher, Euro higher, Pound higher, dollar higher, higher inflation, cutting rates. Aussie lower, New Zealand lower. Aussie's pausing. New Zealand's already cut rates. We're at 4.1 for the New Zealand right now. What's their cash rate at? 4.1 or 4.2? It's a slight positive swap on Aussie New Zealand. If you're long Aussie New Zealand, it's actually favoring the Aussie right now at 4.35. Japanese yen down, New Zealand down, Aussie down, the only currencies. So we have 1, 2, 3, 4, 5 of our major currencies with higher inflation readings. And these central banks are all cutting rates. Interesting. We go into, I said that the data point, one data point doesn't make a trend, but with inflation readings right here, 2.7 came in 2.7, 2.6 came in 2.6, 2.3 came in 2.4, but that was our bottom. So we are no better off. If I just draw a straight line, we are no better off than where we were summer of last year. There you go. So we're right back where we started. Is it slightly lower? Sure, but give it another month or two. If we go another 1/10 higher and we're printing right here, and a 1/10 higher and we're printing here, right? If that's our trend, it's clearly going the wrong direction. Okay. What we don't have by the end of the month, and I actually looked at this morning, we don't have a PCE print in the US. So I wanted to look into that and see what the print was in November. So here's our CPI data. How about the news for this morning's PPI? I looked at the history here. Let's go back to overview. Let's go back to the economic calendar. There we go. So here's our news from this morning at 8:30. Here's all U.S. news at 8:30. So jobless claims up a little bit. Core PPI forecasted 0.2, came in 0.2. Okay, the previous was 0.3, but this is where I think it gets to show us that there was a bit of a miss. Okay, higher inflation. 3.2 is forecasted for core PPI year over year, came in 3.4, 0.2 higher, and also the revision was higher. We had a revision from 3.1 up to 3.4. That is higher PPI. We had initial jobless claims also higher with a revision that was slightly down by 1,000 higher on the revision, but missed by 21,000 on the initial jobless claims. We have month over month and year over year for the regular PPI, not the core, but also 0.2 came in 0.4, 2.6 came in 3.0, and the revisions also higher, 2.4 up to 2.6, 0.2 to 0.3. So just this alone, and I know that this is technically not the preferred measure of inflation, we've been told that it's CPI and core PCE that the Fed pays attention to. Okay, so we've got CPI that came in as expected, but it's higher than where we printed during September's data in October's print. Okay, so we have October, November, and December all printing higher CPI. We have October, November, and December all printing higher PPI. How about PCE? Take a look. PCE. This is US core PCE year over year. As I said, one data point doesn't make a trend, but if I zoom in here, can you see how this looks very similar to the Edgefinder when it comes to the low in September, and we are trending higher? So take a look here. Here's June, July, August, September, October, November, and we're not going to get a print for December. Unfortunately, we're gonna have to wait until January. If somebody can find it on the calendar and show me it's here in December, let me know. But usually they sneak in the PCE at the very end of the month. The market's already kind of digested CPI and PPI, and PCE just kind of comes in, but it does matter. Okay, so we are trending higher. I mean, really, this is kind of interesting. We flatlined in summer of this year with basically the same print. I also find that hard to believe that we've had perfectly aligned, like, oh yeah, PCE is just totally fine at 2.6%. Well, it's 2.8. And on top of that, the reason the Fed has been restrictive is because our official cash rate was well above the core PCE. Well, now it's getting less, right? Like that gap is narrowing. We're going to be down to 4.25% next week. So if we decrease down to 4.25 on the Fed rate, and we look at the core PCE at 2.8, let's say we print 2.9 or 3%. Now we have the Fed sitting there like maybe 1 to 1.5% buffer, as opposed to like a 3% buffer. That's a big difference. So will these paths cross again where core PCE and the Fed rate all of a sudden are aligned? Is that the Fed saying like, well, that's good. Now we're neutral. Now we're no longer restrictive. But that trend, I mean, if you give inflation momentum, I feel like it's going to get hotter. If consumers are stupid enough to keep paying for stuff that's more expensive, you've got way too much money chasing too little goods. That's inflationary, right? We go into 2025 with potential tariffs. That's inflationary. You've got money supply going to everything. That's inflationary, right? You've got China trying to lift animal spirits. That's inflationary. You've got positive sentiment and the assets going and ripping higher in the U.S. That's inflationary. Yes, the best way to fight inflation is to be a trader, to be an investor, to be in these markets, to have assets, to be an owner. So you can offset this. It's not what I'm saying that I want to be bearish all of a sudden, but I'm saying this market is likely going to face another reality check. Okay, so the data is not supporting that everything's looking good. This whole like soft landing scenario, I think we were told that it was coming. The Fed, I'd say, threaded the needle pretty darn well. The market didn't overreact in September, although it could have, right? It didn't. Like August was the Volmageddon event, and September was, fighting the good fight and get right back to all-time highs. And we had a great September, October. The election, lifted the market to new heights, and it's just going to be interesting to see how the rest of the year unfolds. So where are we? We're sitting here near all-time highs. I keep talking about this cushion where I want to deploy cash at better prices. If the market melts up higher, so be it. If somehow we fill today's gap, I mean, and look, I'm not a hater here. I mean, we started off on a rough note this week. We had Monday, Tuesday sliding. The market ripped up on CPI. If this is enough to just keep the market saying, hey, look, it's okay that we had a low on CPI. We ripped up here. We pulled back again. Let's see if this market does have what it takes to hit all-time highs. Can it do it by today or tomorrow? I don't know if the PPI news is going to be that much. But if we fill today's gap, okay, let's say that we fill today's gap. Let me use my drawing tool here. So let's say we fill today's gap, and this gap is still just offering support. Are we able to eke out higher highs? Maybe. Can we get to 6,100 on SPX? Can we get to 609 or 610 again in the SPY? We're right there. Right? We're right there. So you can see everything is in red right now. The Qs have been outperforming, but also you can see that added volatility. We're down 0.2% in the net or the S&P. We're down 0.4 in the Qs, but they've made a really nice rip to the upside. So S&P has not made a higher high since the 6th, which is last week, right? That was our last all-time high. That was number 57 for the SPY. Now, could we get there by the end of the year? Sure. We have the Fed next week. We then have disrupted trading with holidays, but if the market's going to drift when it's open and drift higher when it's open, we could still carve out another all-time high by the end of the year. It wouldn't surprise me. This market could care less about reality right now. Okay? And that doesn't mean that I'm short. Doesn't mean that I'm bearish. It just means I'm getting ready. Getting ready for some type of hiccup, some type of fumble. And maybe it's debt ceiling in January. Maybe it's tariff talk in January. I don't know. Maybe it's the Fed the 18th. If they want to really squash this end of year rally, then the Fed's going to say something to the effect of like, inflation is increasing. We're probably looking to be a little bit more neutral going into 2025. And the market all of a sudden thinks that they're not going to cut it all in 2025. But I don't think the Fed is going to be that definitive and that explicit. I think they should be thrilled with themselves, and they're going to have a holly jolly Christmas because they somehow navigated these markets to all-time highs with cuts and inflation that has had a wild ride the last couple of years. Okay. So anyway, we'll see what happens. As I've said this last couple of weeks, I'm looking for some type of correction to deploy capital. If I don't get it and I just enjoy the melt up, that's fine. I'm going to continue to play some hedges at least to the end of the year. I'll continue to play hedges into Q1. Okay. About gold, yep, we'll talk about everything here. Any bank reports you recommend to read? What do you want to read on that, Devinder? I mean, right now the big story in FX is central banks are cutting. Fundamentally, I'd say your cash rates. I mean, it's an interesting story in currencies right now. It's like the dollar index. Let's talk dollar index for a second. So dollar index is doing exactly what I thought it was going to do. We came back to that 4-hour 200 moving average, and we're ripping higher. Ripping might be a little bit aggressive, but we are going higher off of a pullback. So the dollar from this bear trap squeeze that we called, rip up, pullback, headed higher for that follow through. We came right back into a nice little pocket. We started a bounce there. That actually coincided with it was like was that a PMI crash in the Eurozone? That was back in November, right? That was like a PMI kind of a crashy move where it brought the euro dollar down to like 103.30, and then it went all the way back up to 105.50. That was a big reversal. But here we are. We bottomed out right here. It was a really nice play on the 4-hour time frame, and this thing's up. Okay. Yeah, Swiss yen is working out great, isn't it? Swiss yen is good. Swiss yen is I'll say better. Better. I'm hoping that the rotation into the Swiss getting weaker. This is a really nice looking pattern, so I'm holding this one short. Okay, if this is a larger crown pattern, I've measured symmetry on this one down to 164. I'm going to take some profit on Swiss yen at 164. I'm still holding long in all my other Swiss pairs. So Aussie Swiss, I've leveled in a bunch of times on this one. CAD Swiss, I've leveled in a bunch of times on this one. Euro Swiss, Pound Swiss, New Zealand Swiss, Dollar Swiss. I'm still being very patient on these levels. I got these yellow boxes measuring my symmetry moves. I'm still going to hold these things. Okay, let's go back to the dollar index for a second. So I said this on the 4-hour time frame. It bounced right off the 200 EMA on the 4-hour. It's right here. Okay, so you can go back for the last couple weeks when this thing bottomed out. I said watch for this support at the 200. You got support. You got some direction. This has not been invalidated. So if you are long the dollar, that's a good play as long as this doesn't invalidate with a daily candle close below, and that price is 105.50. Okay, I don't know what day it was, but I said my line in the sand is 105.50. If we stay above it, I'm long. We stay below it, or we close below it, daily confirmation, I'd be looking to short the dollar. It's long. So through the rest of the year, again, with the Fed next week, I wouldn't be surprised if the dollar continues to trend up here, and then we have a range that we have to make a decision on. Is this going to be a topping point where the dollar is range bound? Maybe. Okay, is this dollar going to continue to run hotter going into early 2025? Look left on this chart. This yellow box is also a larger pocket. This is a big inefficiency I have on the dollar index. I think the big surprise for the dollar would be this. If we came back to fill this pocket all the way up, okay, if we form a topping pattern, that would be an excellent way to short the dollar. I think the big surprise to me would be if this dollar came all the way back up here to these multi-year highs. That type of trend would, I think, do a lot of damage in the currency market to see the dollar get that much stronger. That would probably push the euro down below parity again. That might push the pound dollar back down to like 115, 120 or 115. That might threaten some big, not necessarily historical lows, but some big significant lows on like Aussie dollar, New Zealand dollar, if the dollar continues to run hot. Okay. But now that the Fed is going to be sitting at 4.25%, the carry trade is negligible on the dollar. If the dollar's sitting at 4.25 with another cut coming in Q1, if the RBA and RBNZ just hold right now, okay, then they're going to have equal swap to the dollar. Doesn't mean the dollar can't get stronger. Doesn't mean this carry trade is live and well, but it neutralizes some of the appeal of this carry trade. Okay. So I'm watching the dollar index for this area to be either a range trade right in here, where you saw that the dollar had some range potential, right? A lot of these tops that have happened on the dollar have been range tops. So I'm looking for that area to form another range top. And then if we start to break down, there's my trend. All right. So I'm watching for the same high here to be a bottom. If I'm wrong on that, I'm looking for a divergence. If we go higher here, I'm looking for a divergence and then see if we have a topping pattern. So maybe it's a head and shoulders, maybe it's a crown pattern. But if we have a topping pattern, I'm looking to short the dollar on a swing. Currency pairs that I'm in right now, I'm still long Aussie dollar. I'm still long New Zealand dollar. Excuse me. And I'm long dollar CAD, dollar Swiss. Okay. I'm not in the euro dollar. I closed out my pound dollar for a small loss yesterday. I lost like 38 or 40 pips on it. But the Aussie dollar, New Zealand dollar, dollar CAD, those are position trades for me. I'm scaling in and building my positions up. Dollar Swiss, I built that position up over the last 2 years. I was in that since late 2022, started getting positive swap in 2023. I'm still in that trade. Okay. So there's still more to unfold on the dollar side. I'm watching price carefully. This is an easy way to kind of assess the index on where we go with the dollar. Japanese yen, still my least favorite currency pair in basket. The FOMC next week on Wednesday, piggybacked by the BOJ. Watch out for some, late year shenanigans by the BOJ. Maybe they come in swinging with, I don't know. Just be ready for anything silly. Trade short term on the Japanese yen. Follow probably nothing larger than like a 1 hour time frame if you're trading the yen. Otherwise, stay out of it. If I get a better picture, better outlook on the yen, I'll trade it. Otherwise, I just talk a lot of crap about the yen because I hate it. It doesn't trade like a currency to me. It trades like a stock. It's like when it runs, it rips and it goes for thousands of pips and it drives me crazy. There's no structure, there's no pullbacks, there's no pivots, there's no efficiency, there's no equilibrium until later. A move that can go thousands of pips and then it pulls back, it goes, half of that or 38% of it. It's like it does make sense eventually, but those cycles last way longer than I think most traders in a leverage market, especially most traders don't survive those. If you're on the wrong side of the yen, you get your butt kicked. So I would just rather, advise traders, and it's not financial advice, of course, but encourage traders to never fight the flow of Japanese yen because when it moves, that momentum is really, really strong. Okay. All right. Let's see here. If we see unemployment 4.4 next time, you think the dollar would still be strong? Look, let's just talk reality. Okay. Reality check for the U.S. economy. Okay. So we've had a fantastic bull market since 2022 Q4. We got out of the bear market in 2022 in Q4. We ripped hard in October's bottom into November. November was a great recovery into the year, and then 2023 picked up right where we left off. It was mostly led by Mag 7. Led by Mag 7, extended with a broader tech recovery, and then extended further with AI and semiconductors. That's where NVIDIA started to really pick it up. And then everything that was in semiconductor space, SMCI, which is now a dumpster fire, AMD, Micron, AVGO, Broadcom, like even legacy techs like your Intel started to make moves on this, and Oracle started to make moves on this. Dell started to make moves on this, right? 2024, outside of a little pullback in April, which was a reality check because the Fed was still stubborn on saying we're not going to cut rates. Right. And April was a little pullback, 5-6% in the SPY and the Qs. August was the closest thing to a scare because we had that deleveraging in the Japanese yen. We saw that the weekend from a Friday to Monday was the biggest 2-day sell-off in the Nikkei ever, 17+% in a 2-day window, 27% peak to trough. That was a huge drop in the Nikkei, and it did affect the U.S. market in a big way. Okay. That was the closest thing we had to a I'll say Volmageddon event like we had back in 2018 January. But the market didn't care because the typical September effect didn't last. We had that scare in August and the market ripped all the way back up through August to recover. And then September's like, we're fine. We had a little hiccup right after Labor Day and the market ripped higher. We're at all-time highs again by September. So September was actually a positive month. October was another drift higher, and November was a crazy month. Okay. So reality check for the U.S. economy is we've had a bull market running hot since Q4 2022. Now, it doesn't mean we can't go higher, doesn't mean we can't go further. I would say this, the reality check would be the pace of this growth and these gains will likely slow. Okay? Why is that? We can't have a broad market rally when 10 stocks are performing well and 490 are lackluster, right? This whole rotation in this narrow market breadth and this very highly concentrated bull market, that can't last. It's not sustainable, okay? And right now we're sitting here with S&P price to earnings is historically high. Is it the highest it's ever been? No, but we're getting up to that like 26, 26 and a half, 27. The historical average is somewhere between like 17 and 19. So percentage-wise and percentile-wise, we're up to one of the higher levels we've seen in a long time. That's historically high. What typically gives us reversions is historically high valuations and price to earnings. If it's price to earnings, price to peak earnings, price to sales, price to peak sales, all these things are getting historically high. Okay, so what that means is the markets are priced for perfection. So that means Q1 earnings of 2025, which would be Q4 data, it might still carry on into Q1 of next year, right? If you think about how strong companies are in their position in 2024, if we have a good rest of the year, that Q4 data that prints in Q1 2025, we could still have a strong earnings showing. But after that, I feel like it's a reality check. Okay. So if we're lucky to extend this bull market, it's through this year and it's into Q1 of next year. I think that's about my window of like, okay, I could get my head around this thing going a little bit higher, a little bit longer, getting longer in the tooth, getting over its skis a little bit, but there's still room to run. Okay. So could we go into that with a strong Q4 into Q1 print? Yes, we could. But after that, will this hot growth continue? Okay. Borrowing costs are still high. Look at the US 10-year. If the US 10-year yield is higher, not good, right? If you look at where we were in September on the 10-year yield, it was down a lot and it's ripped up 80 basis points from September. That's not good. Everything is based on that, right? Mortgage rates, auto loans, student loans, borrowing costs, restructuring, corporate debt, all of it's based on that 10-year. If that thing is trending higher, that will choke out growth. Okay? So that's a reality check. If it goes lower, sure, maybe things get better and things get cheaper, maybe. Okay? We also have inflation. Okay? It's not going away. So for us to be told 2%, 2%, 2%, we're now trending in the wrong direction. We've got enough data now in 3 prints to show that our trending direction is not down. Okay. Is it going to be a huge second wave of inflation? Remains to be seen. But with added money supply and animal spirits getting lifted, greed and complacency in the market, and tariffs potentially in 2025, I don't know how inflation is going to all of a sudden go back to where it was, down. I don't know how we're going down again. You know, it's not going away. And so the only thing that pushed it down lower was having a very hawkish and restrictive Fed, and they are not that anymore. And I don't think the Fed wants to pivot and wants to raise rates in 2025. So if they do that, that's clearly them being reactionary and showing that there's a policy misstep somewhere. That's going to be bad for the market. But I doubt they'll do that. They'll probably just try to hang in there and hold rates and just stop cutting as much as they've been the last 3 months. Okay, but it's not going away. What else do we have here? You know, I would say just technicals. I mean, technicals. How many charts are above the 50 SMA and above the 200 SMA? It's like 65% right now. Okay. Now that's not historically like, oh, that's a bear sign. No, it's not at all. Okay. But it's how far above are they? Okay. If we see 300 plus bar counts, and this is all technical stuff here. If we see 300 plus bar counts from price and the 200 EMA. I use an EMA for a lot of my moving averages, the 200 EMA, and we see a big stretch away, let's say 10 to 20% higher than 200 EMA, that has pause or reversion written all over it. Okay, that is the reason I said this week that I think NVIDIA will not make all-time highs, but it will rather hit the 200 EMA first. That's what I think. We're at 470 plus bars. We had a 45% stretch away move. Now we're up into the 20s. I think just that reality is it's going to find a way to stall and oscillate and let those moving averages catch up, or we actually have a bearish move. There looks like a pretty good head and shoulders or topping pattern on NVIDIA, on SMH. Pretty much on every semiconductor stock, it looks like there's a pretty big topping pattern. Okay. All right. So all these things. Now, does all this mean crash? Okay. In my opinion, no. I think no to a crash, but I would be fully prepared. Okay. Mentally and financially, I would be prepared as a trader, as an investor, to withstand a 5 to 10% pullback, like minimum. Okay. Like if we talk about crash, then we're going to exceed 10%. We're going to have like a flush down and then another flush down. We might be talking 15 to 20% pullbacks. But if I ask everybody in here, if you have a 20% pullback being offered by the S&P, would you rather be a seller or a buyer? Everybody smart that thinks about the last 90 years of trading should be thinking, if I have a 20% discount in the S&P, I'm going to buy it. And I don't care if it goes from 20% to 30%. I'm still going to establish positions at 20%. If it goes down to 30%, I'll establish more positions. If you want to be generating a huge gain over the next 3 to 5 years, then you would buy a 20, 25, 30, 35, 40, 45, 50. You would buy in at all those levels if you have the cash to do it. You will make a fortune when eventually the markets get to all-time highs. It may take a year. It may take a couple of years. But a 30, 40, 50% pullback is a massive upside gain. But you have to have the cash to do it. And this is why I said this week, my biggest warning out there is for everyone that is fully invested and not prepared for any type of downside. So just saying, I don't think it's going to be a crash, but I would be fully prepared for a 5 to 10% trim. Okay. And it's just going to be a reality check. And I don't know what the catalyst is. I don't know if it's all these things I mentioned. I don't know if everything that happens in 2025 that gives us this potential reality check, it's not even on here. It's something I've never even talked about. It's not even crossed my mind. I'm hoping that's not the case. I'm hoping I'm thinking enough outside the box so there's something on my radar that actually makes some sense to see why the market would correct. But if I'm wrong, it's something else. That's why they're called outliers, because nobody's talking about it, right? But I would be prepared for that 5 to 10% trim. All that is to me is technically pulling back to all my cushioned EMAs on my charts. My daily time frame is so overstretched. It just opens up all those levels. So when I go back and show you the charts here in a second, that's what I'm looking at. The SPY pulls back, the Qs pull back, the Russell pulls back, the Dow pulls back. Any stock, Palantir, Carvana, Progressive Insurance, Geico, Amazon, Meta, Netflix, Apple even. All these stocks look the exact same. So can they melt up higher? Sure, they can melt up higher. But man, I think that I would like to be buying lower. I'd like to be establishing positions lower. And the tricky part too is if you establish positions, just remember they can get worse. And like thinking about the S&P, if it pulls back 10%, we establish positions. The S&P, okay, the S&P could be, I don't know, going to, a 10% pullback that all of a sudden we get to all-time highs. But Apple could pull back, 15%. NVIDIA could pull back 20 to 25%. Netflix could pull back 20%. Meta, we've seen Meta crash, 40, 50, 60%. So just be careful on how you choose your levels. If I'm going to be smarter and kind of, withstand the drawdown, I'd much rather trade the indexes. They can absorb the haystack. There's a lot less volatility when if one individual stock gets crushed, the S&P is going to have that just kind of weighted in, but it's going to be a fraction of that type of fall, So, I mean, if the entire Mag 7 drops, it's going to drag the S&P down hard. It's going to drag the Qs down hard as well. But if you want a little bit less volatility, I think, trading the index is a little bit easier to establish those positions. Okay. All right. So do I think there's a crash? No, I don't think that we're having like a bear market crash. I think it's exhausting to see like the bear porn and the doom and gloom and like you've got this and prepare for the end of the world. It's not that, okay? But I think that the market's going to struggle to rip 20 to 25% higher, 30% higher. We've had a heck of a run in 2023 and even into 2024. This would be 2+ years at 20+% gains. That's only happened 3 other times in history. Okay. So we are in some very rare air when it comes to how bullish this market has been since the end of 2022. When we finally established that bottom in 2022, this market has been ripping higher. Okay. I know I've said rip a lot today, but it truly is like we're talking extended moves, overbought conditions with lots of percentage distances between, current price and these moving averages. And I'm just trying to be patient. So, and truthfully, it's like it's a little exhausting to know that there's better opportunities ahead to like get things at discounts, but to see that it's just not coming. It's not coming yet. It's not coming yet. It's not coming yet. And so I'm just sitting and collecting a little, 4.4, 4.5% position on cash, which is fine. It's unallocated cash. I get a little, I play GOVT and BIL in my portfolio, so that gives me some cash yields. But as soon as I need it, I close out those positions and I allocate the cash, and I've got 40+% of my portfolio in cash right now. Now, if we melt up for the rest of the year and we have a 58th, 59th, or 60th all-time high, we hit another chunk of highs in the Qs. There's more money to be made. There's, maybe another 2 to 5% to the upside for me. And I'll take that upside on a melt up for the 0.25% that I'm hedging. And going into Q1 next year, you're going to see this on repeat. I'm going to hedge pretty much every month. Why? Because if any of this starts to happen, whether it's Q1 or Q2, okay, and there's also typically a honeymoon phase when it comes to a new administration. And I know Trump has been president before, but if he comes back in for a 2025 into 2028 window, usually that president gets like a 3 to 6 month grace period where things just kind of stay the course. And so that's what I'm saying. Q4 data could print very, very well and at least hit expectations in earnings. And if the Fed is going to be somewhat accommodative where they're not looking to pivot and raise rates, but they're still pausing with this 100 bips lower, the market's liking that so far. That's why we've gotten to these all-time highs through the rest of this year. So there's a lot of things that are still fueling, but it just feels like, the gas light is on. We're on the reserve tank right now, and we're just drifting. And I don't know how much farther we can go, but we'll find out. I'm just saying, be prepared for at least a trim. And why do I want to trim because I want to allocate some cash. I want to deploy some capital at better levels. And there's a lot of opportunities to buy an index. There's a lot of opportunities to pick up some good discounts on stocks. Nick and I talked about this in our session we did back in November. I think it's quality over quantity in 2025. I think quality is, even if we have a choppy, not really a crazy bull market, but it's not a bear market. It's just kind of it's just a weird environment where it's like the market maybe gets a little splash reality. It's not gangbuster growth like we saw the last couple of years. And there's a lot going on, right? We've got a lot of potential policy shifts. It's just like, I just think that everything has to go right to maintain the pace that we're on right now. And that's hard to do, And here's the other thing. What happens if the U.S. economy starts to slow? What happens if unemployment starts to trickle higher? What happens if inflation data starts to trickle higher, right? People are already exhausted with inflation. They're exhausted with the economy, feeling like they're no better off. The only people that are somewhat happy would be investors, because 401ks, retirement plans, financial advisors seem like they're the smartest people in the world right now because they're just invested in the markets at all-time highs, right? But everyone's on the hook for the risk. A financial advisor is not hedging your portfolio. I'm sorry. The best thing a financial advisor can do would be sitting in some type of cash that's getting yield and be ready to reallocate and deploy if the market is going to go down. But they're not. What they do is they keep you pretty much fully invested all the time. And you are highly, highly correlated to what the market does. If the S&P gives a trim for 10%, your 401k is going down 10% or more. Because if you're aggressively in, Mag 7 stocks and they have a hiccup, or you're aggressively in Nvidia, or you're trading yourself and you're aggressively in all this stuff that has like high growth, or you're in a bunch of freaking double leverage instruments, you're going to feel it, So I guess I'm using today's session and this whole week, for example, as like a public service announcement. I just don't want anybody to be caught off guard, right? So I don't know what the outlier is. I don't know what the potential catalyst is, but I do know that if it happens, we've talked about it. So I will be on the sidelines with 40+% of my portfolio in cash, just waiting for more opportunity. Now, I still enjoy the melt up. I can still have leverage gains. This is why I trade options as well. Positions still close out. I can still speculate. I can still trade income trades. It's fine, right? But I don't feel the need to be really aggressive at these levels. I think this is the worst possible time to be sitting here going all in. All in was, I would say, after the August Volmageddon event, it was a hard one to say I'm all in, but having some cash to deploy certainly helped. And I was pretty aggressive going into the election. I got paid in that election in a big way. I mean, I had a huge month. My November was up almost 9%. That's a big month for me. Okay. But now we're in drift. We're in orbit. It's what's left in the reserve tank. And I just don't want to be caught off guard and having a big drawdown if the market does, face a reality check. And there's all these things stacking up. And what makes for a reality check? The fastest reality check is a mad consumer that doesn't want to buy anything anymore, a struggling consumer that's losing their jobs. All these things start to trickle higher. Now, initial jobless claims, non-farm payroll, all these things have been historically pretty accurate, or I should say pretty satisfactory. And so, the argument of like what happened in July and August with the SOM rule being activated, that's supposed to be the undefeated recession indicator. Look, all the recession indicators for the last 2 years have not worked, period. They're all wrong, okay? The inverted yield curve, I haven't looked at in a while. How about the 3-month and the 10-year? Okay, I haven't looked at this in a moment. Let's go to the 3 and the 10. We are still negative. This is a whole nother can of worms that it's like, yeah, if we get out of this, you go back to the chart. This is the longest and deepest 10-year and 3-month inverted yield curve that we have ever had. All these vertical lines have triggered recessions. And what are they? It's not the inversion, it's the disinversion. And we are so freaking close to getting disinverted. So just saying, is that a really simple, like martingale, right? Is that the canary in the coal mine? If we get out, all of a sudden this is at the 0 line or going positive like the 10 and the 2-year did, is that going to trigger anything? Maybe, So it could be something super easy to spot. It could be something super difficult, but I'll leave you with this today, okay? This is the reason I am waiting for better opportunities. Okay, you can take a look at any of your favorite stocks on a daily time frame or even a weekly time frame. Look at this. This weekly hasn't hit anything outside of a 21 moving average since fall of last year. Okay, the daily chart is another one. We have had nothing but bounces off of the 21, the 50, the 100. We actually hit the 144 on that Volmageddon event in August. But other than that, this thing has been only moving up with a test of like the 21 and the 50, those very shallow moving averages. And so when we stretch away, and I keep talking about this is the bar count. It's this simple. I don't care what stock you look at. Okay, you can look at freaking MicroStrategy, Coinbase. You can look at all your, Bitcoin ETFs. You can look at Bitcoin. You can look at the NASDAQ. You can look at your Mag 7s. I don't care what stock you look at. If it looks something like this, where the stock is sitting here at all-time highs, and you have all this space between current price and every one of your moving averages, I'm just saying we're probably going to have a pullback. Now, this might have some fuel in the tank to go a little bit higher, and that's fine, right? And this is why we've said this for months now. Don't fight it until price confirms it. If price finally takes out a low, okay, and takes out a previous high, and it's like it's not bouncing anymore, and it comes back and closes below moving average, it's typically going to close below this moving average and gravitate to this one. If it bounces there, great. If it closes below this one, it's probably moving to that one. Okay, but we will spot some type of topping pattern. And usually the markets, if it's going to be like a healthier cycle, we might see the market go up, go sideways, and then start to roll over. That's better than when it goes up and it like freaking, gets hammered down and then dead cat bounce and then hammered down again. But once that's over, look at your percentage and is it worthy of buying? Is it a big enough discount to buy? If yes, I'm buying. If not, I'll wait. But this is why I have cash at the ready. Okay. So it's exhausting, right? It's exhausting to think about like what can happen. But I look, all this like potential cynicism, it goes away when the market has a reality check for me. I've been in these markets for a long time. I know what complacency looks like. I know what euphoria looks like. I know what greed looks like. It kind of looks like this, right? When we've got double leverage instruments that everyone's talking about, when I've got people that have never talked about Bitcoin talking about Bitcoin, when I've got people that have told me about their portfolio being up 30, 40, 50%, they're just going to keep investing the way they've been investing the last 2 years thinking this is what the market is. It's not the market, okay? We are in a unique window of 2 years where this market has been extremely bullish, and that's great. It's easy to make money in a very healthy, aggressive bull market. The real trading and investing comes from surviving a trim and surviving a crash and having the cash to deploy and generate the wealth when the market does something like this. When the market does something like this and you have the cash to deploy and then we get back to those all-time highs, that's where we make a lot more money than just the constant higher highs. But if you don't have the cash and you're fully invested up here, you're just on the hook for that full correlation. And if the NASDAQ is aggressive and it's like, man, the NASDAQ went down 20%, the S&P went down 12 to 15%, you're going to feel that. And all those traders out there with double leverage MicroStrategy and double leverage S&P and double leverage Qs, they're going to feel that. So that's where the cleansing comes in, So all I'm saying is I'm just going to be ready for it. And if it costs me 0.25% of my account every month, fine. The melt up I get paid, the hedge, I'm going to wait for. Eventually, if I'm right, maybe my 0.25 that gives me maybe 2 to 3%. Look, I can hedge and lose. And if I get a 2 to 3% hedge, it pays for itself. I improve my position and I can buy things at a lower price with the cash that I have available. So anyway, this will be like the last time I sound like a broken record. All right. I think it's been on my mind a lot. When I'm able to sit here and have these live sessions, this is what I'm talking about. I'm talking about everything I'm doing in my portfolio. So I don't know if everything we've talked about is going to be the reason certain things happen, but I'm saying that I don't think 2025 is going to look like 2024. I don't think 2024 looked like 2023. 2023 didn't look like 2022. There's never a year that feels like it's so easy, right? This has been a pretty easy year. It still had some bumps and hiccups along the way. If you stayed the course, it was fine. The market clearly was excited about everything going into the end of this year, the Fed cutting, the timing with Trump coming back into office. Look, if Trump didn't get elected president, the guy's probably going to jail. Like, I'm curious what happens in 2028 when he's a civilian again. I don't know. But we won't have to worry about that. And here we are. Like, clearly the country wasn't ready for a woman president. The Democrats probably shot their foot with everything that happened in the election. I don't care. This isn't about a political thing. It's just 2025 to 2028 will be an interesting window. This could be party like it's 1998, 1999, and the market still has room to run because we're sitting here with a strong, resilient economy with the Fed being accommodative. But it's hard to think that valuation this high, inflation starting to go higher and trending higher, the Fed is likely not going to be as dovish and cut. And I keep watching that 10-year. I'm watching that 10-year so closely because it matters. Okay. This thing is up again for the last 3 or 4 days, right? You want to buy a house? If this is going higher, you're probably paying higher interest rates. This goes lower, you get a little bit better discount. But we are a long ways away from where we were when the Fed cut in September. Rates were down to 6% mortgages. They were 6.09. Now they're up to 6.7. That's a big difference. Over the course of a 30-year mortgage, that is a crazy difference in house price. Okay, so if this goes higher and we creep up to mortgages at 7%, there's another thing. Employment goes higher, recession based on a housing market correction. Maybe not a crash. This isn't 2008 all over again, but a correction. House prices come down. Household equity goes down. Everyone's been sitting here thinking their house, I bought this house for $300,000. It's appraised at $1 million. I'm sitting on $700K. We are flush, baby. Well, all of a sudden that $1 million appraisal goes down to $800K, goes down to $750K. You want to put your house on the market? It sits on the market for 6 to 12 months. That's not a good thing. We're sitting here with crazy high housing prices, crazy high interest rates. Nobody can sell because the prices won't sell at these current rates, and nobody's buying at 6.5 to 7.5% interest rates. That's where we're at. So the housing market is at a standstill. There's supply that's coming online, but people can't buy a freaking house. And again, I've got a unique market out here where everyone has money, and we've got home builders that are starting out builder grade manufactured homes that are sitting around like $700K just to get started, $1 million with the trimmings in the lot. $1 million home that is probably a $400,000 house, but it's $1 million. So anyway, I'll cap the cynicism right there. Be prepared for a trim. That's all I'm saying. A trim could be a good opportunity because if let's just say from highs, here's what kind of end today. Okay. If we are sitting here at highs, okay, and we sneak in another couple of all-time highs, that's great. But as soon as we have some type of correction, the amount of effort it takes to get back to that high, we might not have the thrust and momentum to go higher, right? So if all we have is we have some highs, we have a correction, and then the market just kind of plays around with this. And one really good sign for the market is a broadening pattern, because traders get fooled by thinking it's going to crash or it's going to rip, and they get beat up both ways. So 2025 might be the first year in a while that we actually have the price not going higher, not going lower, but it's going to be this. Maybe the market finds a way to end on a high note and be at 10% for the year, but it's after all this volatility. Look at 2015, look at 2016. The market was sideways with 20+% pullbacks. That was not a fun 2-year window. But if you stayed the course and you had a horizon, it's like, oh, just long-term investing. Well, we're not long-term. I mean, yes, we're long-term investors because I'm going to do this for a long time, but I'm trying to find ways to make money this week and this month and this quarter and this year. So I don't care what the market gives me. I'm trying to make money. So I will do my best to continue to assess whatever this is. I have, I'd say, lower expectations for the market in 2025. If we get to a 10 to 15% run to higher highs, that'd be pretty impressive. And so I'm hoping to get there. We maybe have a bit of a reality check first that we can buy into, as opposed to melting up and seeing that the market's up, 15% for the year, and then it gives it all back. And then we spend the rest of the year just fighting and floating and treading water until it finally maybe gets back to the high by the end of the year. So, all right, enough of my forecasting. Am I just spewing cynicism? I don't think so. And look, I'm saying this while I'm up at like fresh watermark highs. I've had a good year. I don't know why I'm complaining, but I think I'm just ready. I'm just ready for something. Like, we need to have something change. We need to have a little bit of an opportunity to have a buying opportunity, because I can't buy at 26 valuations, right? Price to earnings at 26 is historically high. I can't buy there. This type of stretch away move and this type of bar count, I can't buy here. I'm just participating, like little scalps, little income trades, but I am taking all of my trades with this. There's resiliency in my strategies. So if my hedge gets paid, great, right? If my hedge pays out, great. If the market melts up higher, great. I can make money to the upside. I can make money to the downside. I can make money if the market goes sideways, but I'm just trying to be well equipped for whatever the market throws at us. Okay. All right. Next year, quantum bubble AI is old news. Possible. But you got to wonder with that quantum stuff, is that going to change the landscape? I mean, I'm reading stuff like this. Quantum computing is going to be able to, hack the blockchain. Bitcoin's not safe within 4 to 5 years, blah, blah, blah. It's like, I don't know. But it's like everything that is like trying to get your opinion and get your attention is doom and gloom, So I'm trying to be somewhat like balancing out. I'm not doom and gloom. I'm just being pragmatic, Like I said, if you think back, if anybody watching this has been trading since, 2018, 2019, 2020, we've seen booms and busts. And unfortunately, it doesn't feel like we're going to stop doing that. I mean, this to me feels like we've had a boom, For the last 2.5 years, because we got through that October, so just under 2.5 years, this has been a pretty big boom. Is it a bubble? I mean, it doesn't have to burst and be a bear market, but man, like a little bit of a reality check and seeing, valuations at 26 price to earnings go back to 20, go back to 21. Just give us something where it's like things aren't overvalued, things aren't fundamentally strong, or things aren't fundamentally too expensive. So that's it. And like I said, when I see traders that are always talking about, 2x leverage this and it's killing it, I'm doing this, I'm making so much money, it's like, that's awesome. But that's also the trader that rarely protects themselves to the downside. When traders are all in on Bitcoin, they're all in on double leverage instruments, they have no protection to the downside, they're fully invested, they've beat the benchmarks, and they're just out there just like, it's so easy, it's so easy. I get a little contrarian. That's all I'm saying. Okay. So if we have, stalling or plateauing money supply, okay, if we have global liquidity that starts to plateau or shrivel a little bit, if the Fed makes a big pivot where they all of a sudden just start, I don't know, and they probably won't be like flipping policy and raising rates, because that would be an absolute catastrophe if they did. They might, that could be like an easy outlier, like, yep, the Fed just completely messed up and they pivoted hard, and all of a sudden they're raising rates, and it's like the market's going to absolutely hate that. So that in and of itself could be something. But the 10-year and the 3-month is something to watch. The 10-year yield is something to watch. Unemployment rates, inflation data is something to watch. Valuations and price action is something to watch. Nothing about today's price action is suggesting that we're going down. So am I early to this? Sure. But month to month, I'll be in it, because what you can't do is when the market goes like that, you can't hedge that. You got to be in it before it happens. So that's why I'm willing to take that 0.25% risk, because if that happens, that pays me 2 to 3% typically. Is it going to offset all my drawdown? No, but it's going to help me alleviate it, because if I can get this thing down, let's say 5 to 10%, I make up 2 to 3% on a hedge, and I can start repositioning with capital. I mean, I can get that recovery plus the 2 to 3%. I can end up getting to higher highs before we ever get back to the higher highs. So my portfolio can be in a better position well before we actually get back to those higher highs. But I got to pay for that every month, or every 45 to 60 days. Usually I do like 30 days because it's not crazy expensive. All right. So if the market goes up, you lose your hedge money? No, not at all. That'd be like the dumbest hedge ever, right? I hedge with a fraction risk, 0.25% risk. If I go up, I usually get about a 2% upside if we go up like 0.5 to 1%. And if we go down, I turn that 2.5% into a 2 to 3% gain. So, I mean, if we melt up higher, I'll be fine. If I pay 0.25% and I'll just be real. Let's say that I lose every month for the next 12 months. I go 0.25 times 12. Okay. What's the worst case scenario for me if I were to hedge every month and lose? 0.25 times 12. I'm sacrificing 3% of my account that's up nearly 40% this year. Am I okay with the 37% net gain on the year? Yeah. I'll pay for the hedges. So I'm not net even on a hedge. That's the dumbest hedge ever. I pay for very cheap hedges that when they pay out have 5 and 10x returns. That's my style. Does it work all the time? Hardly ever. But in the 1 or 2 times that I need it, like I did back in July and August, I had like a 800% return on the VIX and a 500% return on my futures trades. So that paid for itself. And then it was easier to get to those better positions when we had a rip in September. That got me back. I was at all-time highs in my portfolio before we even got to the all-time highs in the markets. So that's how it works. Okay. Do I place a stop loss? No. That's why I trade options, because it's risk defined. I don't need a stop loss. I can risk the dollar and the percent amount that I want, and I just place the trade, and I can go to infinity or zero, and I'm going to lose the same amount. That's the beautiful thing about options. Risk defined. Okay. Lucas asking about Bitcoin. What do you think they'll do after Christmas rally? I don't know. I mean, I think Bitcoin, if we have a reality check on Bitcoin, we pull back to, I mean, I have this measure move around 107 to 108. The one thing I'm watching on Bitcoin as well is I still like this kind of inefficiency level around this like 90K to 80K. I think this is where the market can kind of check and reestablish some longs. But if we keep going, if we keep going higher and we hit symmetry, I would look for a little correction there. If we end up breaking that structure, we probably have a little bit of a pullback, come back into some like efficiency levels, and then maybe establish some longs. Okay. I mean, I think the trend is decent, but we all know, if anybody's been watching Bitcoin for the last, 8 years, 9 years, 10 years, I mean, I think 50% to 70% is something we have to mentally be prepared for. That's the potential pullback, you know? So could we go from 100 grand back to 30 grand? I mean, that would suck, but we could. Could we go from 100 grand back down to 74? 100% we could. So if this is our previous all-time high, can we find our way back to it? Sure, we could find that again. And then we'll see if the market builds and then goes up to higher highs. But if this goes higher and higher and higher, what I'm going to look at technically would be, if we get a nice high and a pullback, we probably have a run back up to these highs. That's probably where I'm looking to protect and start reallocating and changing up percentages. And I say that because this high and this high with divergence probably means a topping pattern, probably means a correction, and then we reestablish a bull market. So, I mean, 107, 108,000 is my technical target here. That's my technical target where I'm not gonna dump my profits. I've got good positions running, but if it melts up higher through that, okay, and then a higher high with divergence, that's where I'm probably gonna start taking some profit. Okay. Now, how much of that? Enough, because right now my 3% Bitcoin allocation, it's been anywhere between 3 and 5%. Right now I'm showing, I mean, I can look at my portfolio here, but between my Bitcoin positions, let me go to a little bit of everything here. So I know BITO right now is up like 25, almost $26,000. Coinbase is up $5,500. IBIT is up almost $45,000. MARA is up $5,200. MicroStrategy is up $8,500. I mean, I want to protect those profits. Coin, I think I did Coin already, didn't I? Coin's up, yeah, $5,400. So, I mean, my exposure has some good profit. And I want to capitalize on all that profit, and I'll, so my allocation is up. I don't even know what those numbers were, but I'll obviously do the portfolio review. But it's probably stretched my portfolio to now showing that I've got about a 6 or 7% allocation to Bitcoin. I want to go back to like 3 to 5%. Historically, I mean, this is why Bitcoin, I think, is a no-brainer for most traders. A 1% allocation over a 10-year window has produced a 16% average in your portfolio. Okay, if you had a 1% allocation to Bitcoin and you had a 99% allocation to the SPY, okay, you've averaged about 16% a year. Now, that might not sound like a lot, okay, but with that allocation right there, you've essentially doubled the annualized performance of the S&P, which averages around 8 to 9%. So a 1% allocation. So I thought, well, I can justify 3%. Because if I put 3% in, all of a sudden this becomes a 25% average or a 30% average. That's pretty good. But is that how I'm invested? Is 1% Bitcoin and 99 SPY? No, of course not. I'm way more diversified than that. But I'm able to justify having a 3 to 5% allocation because I may introduce a little bit more volatility. But now that I can trade Bitcoin and trade options, I can control that risk and also control that downside and protect myself too. Okay. So a lot of ways to think about it. You're just playing chess. That's all. Do I mostly trade options? Yep. I mean, I moved an $8 million currency fund, took a large portion of that, and now I'm trading stocks and options and futures simply because I can trade options most of the time and control my risk. I mean, I'm up nearly 40% this year with I think my biggest drawdown was about 7% this year. That risk-adjusted return is pretty good. It's like one of the best I've ever had. So, I mean, to me, it was the right decision to start navigating my portfolio into this arena because I just think about all the forgiveness that I have if I'm wrong, right? If this, it doesn't matter what it is. This could be any stock, whatever. If this thing goes up to infinity or down to zero, my trade is right here with defined risk. So if I risk, let's say 0.25% of my account and I'm wrong, that's all I lose. And I could be dead wrong in price. But if I win, I can usually get maybe a 0.5% winner. Maybe I've got a higher asymmetry upside where I can get like a 1% winner. But if I'm wrong, I'm only risking that, So imagine building a portfolio with having upside of, 2 to 3 times what you're risking, but your downside is always risk defined. I can survive forever and be dead wrong. Options is the only asset I know to do that. So that's why I trade it. It's a game changer when it comes to managing your portfolio and having better risk management. Okay. All right. So look, I've been all over the place, right? I mean, I started trading stocks when I was 18 years old in the year 2000 and was, passively investing for 20 plus years. That's easy. That's not what I do now. I mean, I learned to trade from professionals. I've been on the institutional floors in banks. I've seen what banks do. I see what market makers do. I see what retail traders get used for. They get used for liquidity. But I'm a retail trader. I don't have institutional stuff. I've seen the tools and resources. It's like, but it's really no different. I just don't have the capital to build. I did this conference in Australia, and there was a high frequency trader that's been in the institutional side for 20 years. He has tools or had access to tools that I can't use. So the best thing I can do as a retail trader is be better at risk management. Unfortunately, that's what most retail traders suck at, is they manage risk like idiots. They're all in, they're over leveraged, and they're overexposed, and then they get smoked when the market's not going exactly where they need it to go. And when you're trading things like futures, you trade things like Forex, if you're not super precise and super disciplined, it's so much leverage and you have to be right. Look, with options trading, I can be so wrong and lose no more than what I initially started the trade for. I don't know what other asset you can do that with. I can whiff the direction and be wrong. Like, look, NVIDIA can go down to 0 and I would lose, 0.25% of my account. Okay. Like, what Forex pair can you do that with? What futures contract can you do that with? None. So options trading will help everybody if you want to learn how to trade it. It's the greatest asset to trade, in my opinion. It is what brought me to I would consider myself a professional trader. And even that's putting it loosely, just because, look, I work for a hedge fund. You can do whatever you want and you can make the biggest mistakes and you can blow up your account. If you got deep enough pockets of the hedge fund, nobody notices, right? That's not me. I mean, I would say I'm fairly conservative. I've got capital that I care about. I've got client capital that I care about. I trade it like it's my own. All I'm trying to do is not lose money. The profits come mainly because I don't lose money. Markets aren't that hard if you don't lose money. Okay. All right. So anyway, if anybody's interested in learning options, I've got plenty of stuff. If you're involved with the Pulver alerts, if you're involved in any of my services, I mean, I teach options like crazy. The easiest way to get started, I've got basically 2 crash courses called Practical Options. One of them's $27. The other one's a full service at $497. I give you the $497 bonus if you get the Pulver alerts with the VIP membership. If anybody's in my services like Daily Profit Play or Waterfall Income or Double Up Alerts or anything with Prosperity Pub, I give that away. So I'm here to help. I am a trader just like all of you. I'm a retail trader just like all of you. I just been doing it for a while, and so that's why today it sounds a little bit more public service announcement, right? Like that's kind of the mood I was in. But it's just it's strange to watch the market do what it does. And look, I know that the reality of this seasonality is like right now, why would the market go down? I mean, you know how pissed investors would be if the Fed fudges up this rally by the end of the year? So it's probably not going to change. Expect to see the market go to another all-time high or 2 or 3 by the end of the year, just because it can, just because there's nothing to prove that it's going the opposite way. But when it rolls over, just saying, be prepared for that trim, and the news and all the things that the reasons why it all just lines up after the fact. But right now, it looks a little overextended. It looks a little, long in the tooth. It looks a little divergent to me. It looks a little complacent. Looks a little everything. It just looks high, and I know it can keep going. But once we blew the top off in the election, and we had a nice pullback and then another rip higher, and we're just getting these tiny little all-time highs. This feels a lot like the top was in July. These tiny little 0.1% higher all-time high. It's like the news just says all-time high, when it's like it's 0.1% higher. You know, like there's not a lot of momentum behind these all-time highs. So it's just melting up. So I just think this drifts until it's ready, and then we start to see reality. Okay. But reality doesn't mean crash. It just means let's get a correction. Let's get something we can work with. Let's get something we can buy a dip on, and we'll see what 25 has in store. I'm as excited to trade in 2025 as everyone else. I just don't think it's going to be as easy as it's been the last 2 years. So be prepared to navigate some tricky waters. Okay. Gold. Yep. I'll take, oh my, I've been running for a while here. Do I have, hang on a second. Let me make sure I'm not missing anything. Okay. I'm good. I'm good. Yeah. Okay. Let's take a look at gold. Just want to make sure I didn't have anything on my calendar. Okay. Well, if you've been with us in these live sessions for the last month, somebody tell me what I've said on gold for the last month. Am I buying gold right now? I bought gold right here. That's a 100 moving average. I'm going to buy more gold right here. That's a 200 moving average. There's trend line support. There's good structure back here. There's a high, low, lower, high, lower, low. That's what I'm waiting for. Okay. If the dollar is going to get stronger, that's probably going to put pressure on gold. So if gold goes down here, we're back to the range. We're back to that same candle. So I talked about this. This could be just chop city. We're not making highs or not making lows. It's just going to be, a little liquidity grab all over the place. But because we had such a good bull market, this is a fifth wave completion. I'm at least looking for an ABC correction. If that's all we get, I'll get long on gold and I'll hold it long term. But I'm not forcing trades. Okay. So whatever happens, I mean, if it gets all-time highs, awesome. If it pulls back, I'm buying more here. If it gets all-time highs, I'm just riding the wave in the melt up. Silver, same thing. Okay. Silver's pulling back in a big way. Fine. Does this do any structural damage to silver? Not really. It's still well supported around 29.50. It's still really well supported at 26. I just don't want to see it get down to 26 because then all of a sudden we change the trend. Higher highs, higher highs, higher lows, higher lows. If we get back down to 26, there's a lot of support there becoming, or this is resistance becoming support, but that would change the structure of this trend. So I'm hoping that all we're doing is kind of building and basing here, and then we are justifying another rip on silver towards 2025's upside. So I still like silver a lot more technically than gold, but they both have their place in a portfolio. And then Bitcoin, same thing. I've got a measured symmetry move right around that 107,000. It's like 107 to 108,000. So if there's a reaction to that, that's just a measured move. That just shows how technically pure Bitcoin can be, just like with Forex currencies. This is why I don't like the Japanese yen. But if we hit symmetry and it retraces, okay, so all we do is kind of break the structure, maybe have a bit of an ABC, pull back into this area. I'd like to buy more and then see if we go up. That could be a healthy bull market. We'll keep an eye on it. But I want to buy more Bitcoin at a better price. So I was aggressive. Look, I was aggressive for months on Bitcoin. Lows, lows, lows. Averaging in on Bitcoin. Breakout, added some more. That run to 100K, that was the story that everyone was talking about with the potential of Bitcoin running to 100K. Did it get there? Yes, it did. So, my trades paid off nicely this year in Bitcoin. All the while this was happening, I was saying for months, I'm like, look, I've got this allocation to Bitcoin that hasn't performed yet at all. And so if there's anything on Bitcoin and anything on China, there's some big boost in my portfolio. And I've gotten most of those. China's been a bit of a tricky one because we've had these big jumps to the upside and then they just fade so fast. So I've limited some of that concentration in China. I only have like 3 stocks now, and I own 2 of them, and I'm trading options on all of them. So it's defined risk. I have some ownership. I'm working my cost basis down when I can, but I'll repair those, and I'm just looking for income plays at this point. I was going to be more bullish if it was follow through, but we're not getting the follow through on China, so I'm not going to be crazy bullish. Okay. What do you use? So yeah, it's right here. It's the 21, 50, 100, 144, and 200. Very simple. They're all EMAs. EMA. Okay. And usually I'm referencing these on a daily time frame, especially when it comes to stocks. On currencies, I'm looking at a 1 and a 4 hour chart. And then if I'll take it, like if I like the direction of a 1 hour, 4 hour chart, then I'll transfer that down to like a 30-minute or a 15-minute. Okay. And I can, if I have to get in the trenches, I can trade a 1 and a 5-minute in currencies, but I rarely do that. I will do that in futures as well. 1 hour in futures, 1 and 5-minute in futures, but daily charts. I mean, it's the nice thing is that it translates nicely on every time frame. It's just these are kind of my go-tos. So really simple moving averages. Well, exponential moving averages. Simple meaning it's easy to review them. But don't get confused with there's smooth moving averages, there's simple moving averages, there's weighted moving averages, there's linear moving averages, there's triangular weighted, blah, blah, blah. Exponential moving averages is my favorite. Okay, EuroCAD Mason, no trade, man. I don't like it. Dollar CAD's the only CAD I'm in right now. CAD Swiss long, dollar CAD long. That's it. All right, everybody. I'm going to let you go. A1 trading team, thanks for letting me stick around and rant for another, typically 15, 30 minutes and longer than usual. But I don't know. We had a good message to get out today. Okay, thanks. We'll see you tomorrow. All right, bye.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.